members and our staff na wageni wetu, good morning. Welcome to this public participation on the Finance Bill. And we start with a word of prayer by Honorable Kasim.
Let's pray. Almighty God, who in your wisdom and goodness have appointed the offices of leaders and parliaments for the welfare of society and the just government of the people, we beseech you to behold with your abundant favor as your servants, whom you have been pleased to call to the performance of important trust in this republic. Let your blessings descend upon us here assembled, and grant that we treat and consider all matters that shall come under our deliberation in so just and faithful a manner as to promote your honor and glory, and to advance the peace, prosperity, and the welfare of our country, and of those whose interest you have committed to our charge. Amen.
Thank you very much. Let's start with the introduction from Honorable Biego.
Thank you, Session Chair. My name is Paul Kibichi Biego, Member of Parliament, Chesumei constituency, that is in Nandi County, and I'm a member of this Finance and National Planning Committee. Thank you.
Good morning. My name is Kasim. I'm the County MP for Mandera and member of this committee.
And I'm CPA Julius Ruto, Member of Parliament, Keses constituency, and a member to this committee.
Joseph Oyula, Member of Parliament for Butula, and a member of this committee.
Yeah, we have a very big group of staff, but I will request clerk of the committee and Director Legal to introduce themselves on behalf of the others.
Thank you, Chair. My name is Benjamin Magut, the head of Secretariat.
Thank you, Chair. Good morning. My name is Jenny Fandeto, Deputy Director, Legal Services in the National Assembly. Yeah,
since you have seen the members and the staff representatives, we are not going to do introduction for everybody now, but you introduce yourself as you take the floor so that we save the time, right? Although even if we do it, it's almost the same thing, but I tend to think it will take a bit long. For some more people who came a bit early. So I don't know, we have boats. Where is boats? Ian Magari. Okay. Maersk Kenya Limited and Shell Vivo lubricants. We have that group? Yeah, you follow, right? ICPAK, our friends. You are in how many groups?
2.
Okay. ICPAK third. East African Devices Kenya Limited. Wako. Wajavika. Ishaban. I know is my friend. Those are 3 now.
Those are just 2, Chairman.
Okay. Kenya Property Developers Association. Yata. Okay, fine. Let's start with the boats. Introduce yourself and start the presentation, please.
Thank you so much, Mr. Chairman and honorable members, and thank you for the opportunity. My name is George Abasi Nengo. I'm public policy lead for BOLT with my colleagues.
Just speak up, eh?
Yeah.
Use the mic, please.
Thank you. Thank you so much, Chair and honorable members. My name is George Abasi Nengo, the public policy lead for BOLT. I'm with my colleagues, John Campbell and Celia Kuria. And my task is just to introduce my colleagues who will take us through very quickly certain concerns that we have with the bill. So I'll hand over to John and Celia to continue. Thank you so much, Chair.
John Campbell is my name, tax lead at Bolt.
Yes, Celia Kuria, tax manager for Bolt.
Okay. So I think John will start, or Celia, then we, yeah. I think John to start. Thank you. Yeah, so I'm being asked to start, just introduce the company. As you know, Bolt is a ride-hailing company that operates in various countries in Africa. We're in about seven countries in Africa, and we are majorly in Europe. And so, Chair, as you know, that the ride-hailing sector is regulated by the National Transport and Safety Authority, and this industry, Chair, in the last several years has grown. And we provide employment to different cadre of Kenyans, majorly the youth, and our industry cast across cars, border borders, and tuk-tuks. And Chair, over 70% of drivers operating rent their cars from third-party players. So the demography that ride with us or that operate under our platform are between 18 to 35 people. 18 to 35 years, basically the youthful demography. So I'll just hand over to John to quickly just finish up, take the rest of the part, and then, yeah. Thanks, John.
Thanks, George. I'll take it over. Honorable Chair, you'll remember last year they introduced e-teams, which is an invoicing mechanism, electronic invoicing mechanism. In this bill, there's a very good provision, Section 43 of the Finance Bill, is proposing some exclusions from e-teams. These exclusions are payments for imports, payments of interest, etc. So our prayer today is that our industry be included in some of those exemptions, and I'll explain why. So the current wording brings the ride-hailing industry into the ambit of e-teams, and there are certain complexities in our industry that make it very difficult to actually implement. The first thing is the volumes. We generate millions of invoices every day. I don't want to quote the exact number because of the Hansard, but there are very many. They are in the millions. And this big volume would mean that every single invoice would be subject to e-teams. That creates an administrative challenge for us, as I'm sure you can understand. Passing millions of invoices every day through e-teams is creating a challenge for us. Secondly, how the industry is structured means that the drivers are the ones invoicing the passengers. So certain complexities of it being a third-party invoicing has posed a challenge for KRA, if I can speak plainly, Chair. KRA is still not ready with the infrastructure to help us invoice properly. So even though it was implemented in 2024, there's no mechanism for us to actually implement it practically. For these reasons I've quoted, we are requesting that Bolt be included in the exclusion, and that is the ride-hailing sector as well as the food delivery industry. Okay, I'll proceed on to my next point. And if you'd like to follow along, that's page 10 of the slides. So Section 36 of the Finance Bill has changed some things from being exempt from VAT, from being zero-rated to exempt. The effect of doing so means that we cannot claim input VAT on some of these things. The specific items that affect our industry are the motorcycles of tariff heading 8711.600 and electric bicycles. These are vehicles that we use as Bolt. You know, I'm sure you're familiar with Buddha Buddha, electric Buddha Buddha. So by doing this change, it effectively makes them more expensive. And this is leaving a very vulnerable section of the economy to pay more, basically, because the manufacturers are likely to pass on the cost to the Buddha Buddha riders. So our prayer here is that it be reconsidered, that we retain it as exempt, so that we're in quite a vulnerable position of the economy, an opportunity to create a livelihood for themselves. So I'll pause there on the 2 points, the first point being e-teams, the second point being VAT, to see if there are any reactions or questions.
Yeah, no, just go on.
Okay, thank you.
And let me tell you, you are alive,
Okay,
but I'm not saying that you tense.
sure.
You are alive.
Okay. Yes, I'll pass it on to my colleague, John.
Kenyans are seeing you live.
Right.
Thank you so much. I'll handle data protection, and that's more on personal data. With respect to Section 52 of the Finance Bill and Section 59 of the Tax Procedures Act is being proposed to be amended by deleting subsection 1B. So it is our humble plea that we safeguard the data belonging to our clients, to the taxpayers, and this is more of a broader implication, has a broader implication, because the data being held is sensitive, is personal in nature, and opening up the provision of personal data, whether to the regulators or the tax authority, can, in some instances, be subject to misuse. And this is in line with even the global rules, like GDPR, which restricts the data to be used only for the purposes that it's meant to achieve the intended goal. Now, the deletion sort of expounds and almost releases everything, including what is not necessary. In our systems and applications, we normally collect data for various agencies, for various uses, even for purposes of assigning from an automation perspective, we would want to know where you are located, where you are headed, the points where you are even domiciled, and therefore, if we end up releasing this data, you would believe me that you would feel like you're already exposed. And therefore, we are proposing that the section 52 be deleted in entirety. Then I would want to move to the next section 12E of the Income Tax Act. I know this is not part of the Finance Bill 2025, but you would recall last year in our engagement, the significant economic presence tax was introduced at the rate of 3% of the turnover. And the assumption on that basis was that the industry, the digital marketplace players, already were presumed to be profitable and therefore assumed to be paying corporation tax at the rate of calculated at 10% of their total turnover. I would want to submit that not all digital market players are profitable in this context, and therefore the assumption was broadly generalized. It's on that basis that we felt like we need to revisit this, that 10% of the gross turnover is deemed too high. You would recall that initially we were operating under digital service tax, which was at 1.5% of the turnover. And we feel like it's time to revert to that, having taken a period to study the impact of this. The expectation is that we would have doubled the tax payments, but based on our research, based on our own submissions, based on our own declarations, the tax has not doubled. It has actually reduced. The investment that goes behind earning the commission service fees from digital market players is so high that from the turnover that is already collected, that goes towards reinvesting in what we normally call demand incentives, incentivizing people to come into the applications. Now, what happened is that the amounts that were being reinvested were shaved off to cover taxes. And now we have seen a systemic complaints even from our players, even from our participants, even from our partners, that some of them are even dropping off, and we couldn't even support them. That's why in our proposal is to amend section 12E and delete 10% and replace that with 5%. That's our submission.
Okay, thank you very much. And before I hand over to the chair. Members, any question, qualification from the board? Yes.
Okay, thank you, Chair. Session Chair, now that the substantive chair is in.
I'm still the chair.
Yes,
before I hand over.
There was the issue on e-teams. I was really following up. And the way you are bringing out, it implies that the requirement of e-teams will cause production of and generation of several invoices. I'm trying to relate that particular act of generating invoice and the way the nature of the business is, which is digital. And there are ways that whenever there's a transaction going on, because I know it definitely have to go on, even when I book Bolt for service, immediately I'm able to pick the driver to come for me. As you hand the right, the bill comes out automatically. And there are ways that that thing can be synchronized or integrated so that at that point of generating the bill digitally, so the invoice digitally, and so these e-teams can work digitally, because the way you are bringing out, you are demonstrating the cumbersome nature of the work that is not workable. So then I thought the nature of the business is digital. So can also the business accounting documents, generations, be digital, because payment is digital, reporting is digital. Where does it vary?
Yes.
Yeah, any other member? Yeah, section 12E3 on the income tax, on the significant tax, significant economic presence tax. You said that the tax went down instead of going up, if I remember. Do you have data to show that? You can now take those two questions here.
Okay, thank you. So I can take the two questions. The question number one was about the simplicity or complexity of integrating the e-team system at the point of issuance of an invoice to a passenger. So we have engaged the tax authority, KRA, on several occasions and requested and even showed our infrastructure to the KRA team, because they are responsible for developing and designing the solution that would integrate and relay data directly to KRA. As you may be aware, as we speak right now, almost 10,000 or 20,000 drivers are on the road. And the law as it is that when you are light, if you're coming here to the edge, you expect to be given an e-teams compliant invoice. When we explained the architecture of our design, almost all ride-hailing companies, it has been over 12 months now that the solution has not been availed. It's not the complexity from a KRA side as it is now, because what we are lobbying here is you can exclude us because of the complexity in integrating all these passengers. A driver takes almost 15 trips. And you can now imagine, we had been explained that the driver can carry the handheld device and get you an invoice. We don't have parking, we don't have anything here in this country. When you are being dropped, it's a quick fix. And that's why we are saying exclude us until even such a point when these infrastructure...
Chair, I think so that it doesn't proceed to mislead me.
Yeah.
I feel you're misleading, because I'm asking from the point of view in that system integration. Do you have any problem to engage KRA and integrate that system you're using, that system that generates those bills? Because it's not manual. However, 20,000 drivers now that are all over, the system is automatic. I book in online, I log in through my phone, I request for the ride, the system selects a driver near me, I accept through the app, I book the ride, at the end of my journey, it terminates, the bill comes to me through the system. I've never seen anywhere the driver interfaces manually, you know. So I'm asking, do you have any problem in that system that is used worldwide, and especially the domain of Kenya, to be linked with KRA so that automatically that issue of e-teams is sorted out? That's what the information I need to know from your hand.
We don't have a problem.
And maybe CPA even, just an example, the same way that you're able to take a taxi and it automatically deducts money from your account when you reach your destination, you just configure that system like that so that in addition to the details it has of the customer, it has my PIN number. So that when now I disembark from where it is, that ETR receipt is automatically issued. It doesn't have to be more complicated than that. Or what are we missing?
Yes, chairs, it's possible. But on the government side, which has to enable that connectivity, that's where there is a...
Oh, so the challenge is KRA is not enabling that?
Yes, and we've been engaging for quite some time, and right now we need a solution, and we believe that excluding us might be the solution. That's the quickest.
Don't worry, excluding you is not a solution. We'll have KRA here tomorrow, and we'll ask them to engage you and have you integrated. So if the problem is their system, that's going to be fixed.
Chair, I just wanted to ask.
Yes, Honorable Paul.
I wanted to ask them: have they been having engagements with the KRA on the same?
Yes, on several occasions, and even up to now, no solution has been availed. And if you recall, the first time meetings came into place was 1st of January 2024.
So if you are if you are excluded, that means you're not going to be paying taxes.
No, the exclusion of remember the invoices we are referring here that are issued when you end the trip are not Bolt invoices. It's an invoice issued by that driver who is a small trader, if I may classify it in this context. And you remember that even in the previous bill that was there in 2024, there was exclusion. If I may remind you about avocado farmers who are there and the likes of that. So this is the kind of exclusion we are talking about.
Bolt is an international company. It's not an avocado farmer.
If the solution is, the only challenge, chairs, is that the law is there, but then you can't implement in isolation. So it would be a bad picture to say that we are non-compliant, yet we are willing to be compliant, but the enabling authority has not yet prepared that integration.
And maybe, Chair, allow me to make some correction here. I think the law that was amended did not exclude avocado farmers, but rather it gave responsibility to the procuring entity to issue what we call reverse invoice, not exclusion. But at the point of supply, the buyer, the budget of that particular, in that merit, will issue what we call a reverse invoicing.
I agree with you, but if I may explain in this context, the reverse invoicing is where you as a passenger is the one who was authorized by KRA or should be authorized by KRA to raise an invoice on behalf of that driver. Now we are a third party who issues invoices on behalf of others. So the reverse invoicing is working as far as I'm aware. But in our case, it's a third party issuing invoices on behalf of someone. That is where we don't have that solution.
I think KRA are coming tomorrow. We'll engage them on the same. Maybe probably yours can also come. Yes, we engage on them. But being excluded, Bolt is not it's a big company. I mean, we cannot treat you like multinational. We cannot treat you like avocado farmers. So we have to treat you at the level which you are supposed to be treated at. Yeah, I think we are done with you. Are we through?
Thanks, Chair. Sila, did you want to say something? No, thank you so much. We really appreciate your time. Thanks.
Okay, thank you very much, Chair. Let me hand over to you. That is Bot, big multinational company with over 20,000 drivers who are earning. Actually, you are doing a very good job. I may say that. But the issue of being excluded, that one is where I have a problem. Yeah.
I may wish to clarify that by saying being excluded, it's not Bolt that is being excluded. It is the drivers who are using applications like Bolt. So you can now imagine Bolt drivers. You can even imagine a matatu carrying you as a single passenger and you request for an invoice. That, or even a boda for that matter. So we are now here representing the masses in this case, not the Bolt, the multinational company.
Maybe, Chair, so that we don't deliberate on this so much, maybe in future, if there is need be, we can still engage the users of the system so that we can understand who owns the system. Is the system that we are using a platform for Bolt as a company, only that when the vehicle owner registers with the Bolt, of course, for service provision, but the real system is not owned by the driver, neither the owner of the vehicle, but owned by the Bolt. That's what our imagination, but I think it will serve better if we have another engagement, if Chair will allow, so that we seek to understand about what you explain.
Thank you.
Thank you so much.
So thank you very much, Paul, for your submissions. I do direct that our Secretariat extend an invitation to Kenya Revenue Authority for a meeting tomorrow morning with yourselves so that these matters can be addressed.
Thank you.
Thank you.
Thank you very much, Paul. My name is Kuria Kimani, MP for Mono, the chairperson of the committee. Thank you, Session Chair, for holding brief. Our next stakeholder is Mask Kenya Limited. So introduce yourself and take us through the submissions.
Good morning, Chair, honorable members. My name is Fred Kimotho, working with Deloitte East Africa. We are going to present two sets of submission, one for Mask Kenya Limited, and the other one is for Shell and Vivo lubricants. So if you allow us, Chair, we will start with Shell and Vivo lubricants, and maybe I can first introduce the team.
Good morning, Chair, members, honorable members. My name is Charles Musioka from Deloitte.
Good morning, Honorable Chair, members of the committee. My name is Marlene Blessing from Deloitte.
Very well, that's the team, Chair. So as I said, we will start with the Shell and Vivo lubricant submissions. We only have two submissions. And to start us off, will be Genesio, who will present Shell and Vivo, maybe to give us a brief overview of who this company is and why we are in front of you today, and then we can dive deeper into the specific submissions. Over to you, Genesio.
Thank you, Mr. Chair. My name is Mugo Genesio from Shell Vivo Lubricants. I'll just make an introduction, then I leave the experts to do the presentations. Shell Vivo Lubricants.
You know why Genesio and I are laughing is we know each other from a different sector. So I have a challenge separating Genesio of Shell and Genesio, the chair of Kenya Dairy Board. So you can imagine now dealing with milk and energy at the same time. Proceed.
Hey, thank you, Chair, for that clarification so that people don't wonder what is it that we are smiling about. Shell Vivo Lubricants is basically what you call Shell, which was the first lubricants company introduced in Kenya in 1955. I think that should be older than all of us, 70 years operational. And bottom line is at the moment, we are owed about 1.3 billion Kenya shillings in terms of VAT refunds alone. Forget about other refunds, about VAT alone, 1.3 billion shillings. And this has come because the rate of accumulation of refunds is higher than what has been allocated for monthly refunds. So on every month, the rate continues to accumulate in terms of the refundable. As a result, we end up having bank interest rates to an extent of 260 million per year. That's because all the money that we have lent KRA, we have to borrow it from the bank to be able to operate. The simple solution is easy, is an offset. I know, Mr. Chair, we've discussed on this matter with all of you a couple of times, and we agreed that in actual fact, an offset has been provided for in law. Unfortunately, after that, we had several engagements, but finally it is being said by both Treasury, Minister of Finance, and KRA that the law is still not clear about the offset. So the proposal today is we amend the law to allow express offset of the input VAT from import services, that's the import raw materials, so that we can be able then to have a benefit of anybody who thinks about exporting more than what we have.
Excuse me, you are saying, how is the law not clear on the offsetting?
In our discussions, Mr. Chair, with both KRA, we had a meeting with the CS, we had a meeting with PS Treasury, CS Treasury, PS Investments, KRA, and National Treasury. They have said in the definition of input tax, second definition B, definition of input tax, talks about only paid taxes but not payable VAT from import services. So because of that, they say it is not included. But I can have the tax experts explain more.
You know, we are getting different figures. We had a discussion with KRA the day before yesterday.
Yes.
And this is the report from Kenya Revenue Authority that due to that installment adjustment vouchers, that offsetting,
yes,
they were able to, taxpayers did offset 42.14 billion of corporation tax, 7.33 billion on pay-as-you-earn, 3.698 billion on domestic VAT, 34.4 billion withholding tax. Yes. And these are taxpayers that were able to offset those particular taxes. So when you say it's not clear, then I think you may need to tell us how we need to make it clearer then,
yes,
so that you're able to offset.
That's what we want to present today, Mr. Chair. Thank you.
And maybe, Chair, before we go to the specific proposals that we have, maybe just to explain a bit in terms of where you're coming from. And I agree with you, actually, most of the taxpayers have been able to offset. Again, is a tax head that you have mentioned. You have mentioned pay-as-you-earn, mentioned domestic VAT, withholding tax, and also installment taxes. So the offset is enabled by Section 47(1)A of the Tax Procedures Act. And when you read it, and because we have had several engagements with the Revenue Authority, while they do agree that there is no ambiguity as far as those tax heads that I have mentioned are concerned, they are of the view that VAT that relates to imports, imported goods, is not covered under that particular provision. I want to imagine that the amendment that was done some time back to include input VAT was also expected to extend to VAT on imported goods. However, there is a technicality when you read what input VAT relates to under Section 2 of the VAT Act, and it basically only covers the domestic VAT. So, Chair, the reason then we are here in front of you today is to try and make this provision abundantly clear so that then Shell and Vivo and maybe other players in the sector are able to utilize the overpaid tax against VAT on imported goods. So with your permission, Chair, I will welcome Malin, maybe to take us through the first submission. Then my colleague Charles will take us through the second one.
All right, thanks, Fred. So as my colleagues have mentioned, what really is before us is the Finance Bill of 2025 seeks to amend Section 47(1)A of the Tax Procedures Act by essentially deleting the words input VAT from the provisions of the TPA. And our proposal is that that particular provision of the Finance Bill, Clause 50A, actually be deleted in its entirety. And the reason why we are proposing for that is, one, the Chair has actually also mentioned that, one, taxpayers are already able to offset. They are able to offset their tax liabilities, and a reading of Section 47(1) actually speaks to existing and future tax liabilities. So the existing provision of the law actually sufficiently covers taxpayers. And so far as we have actually heard today, taxpayers have been enabled to offset corporate income tax, VAT, pay-as-you-earn, withholding tax. And in our view, the reason why specific reference to installment tax and input value added tax is provided in law is so that we can avert any potential ambiguity that would be to actually just make it clear that even this is provided for and taxpayers are able to offset against installment taxes and input VAT. Now, I believe we understand the spirit of the offset and why it was introduced. There are many refunds that were unpaid to taxpayers, and therefore this provision of the law was introduced to sort of ease that pressure on government, but also for businesses to be able to have a solution for taxes and refunds that remain unpaid. Now, deleting the specific reference to input value added tax may be construed to be discriminatory in the sense that it may be construed to exclude input value added tax from the taxes that are actually within the ambit of offset under the Tax Procedures Act. So the Tax Procedures Act, as I've said, mentions an ability for taxpayers to offset existing and future tax liabilities. Tax under the TPA is defined as a tax that is imposed under a tax law. And the tax law under the TPA at Section 3 is further defined to include taxes that are imposed under the Income Tax, Value Added Tax, all those Miscellaneous Fees and Levies Act, all those pieces of legislation. So actually deleting this actually may be, in our view, a bit discriminatory. And I'd compare that with a company like Shell that has many imports for raw materials, means they have to suffer import VAT a lot because of the nature of business that they are in. In that sense, as it is now, it's not clear whether they should or are able to offset import VAT. Compare that with a company in the service industry whose costs are mainly employment costs. You see, the express provision, there's no express provision in Section 47 that speaks to pay-as-you-earn, but they are able to offset because the law provides that you're able to offset against any future and existing tax liabilities. So that deletion of input VAT may actually be construed to exclude import VAT, and our view is that that should actually be reconsidered. It may be discriminatory in the sense of from industry to industry, service to service. Other taxpayers may have a benefit that other industries may not have. And as we all know in the room, taxes should be neutral. We should have that sense of neutrality in the application and administration of taxes. Yeah. I think that's our submission in the sense of we should recognize that the introduction of the reference to input VAT in the Tax Procedures Act was only to make it clear, and excluding it now will then cause, in our view, further confusion and may actually lead to a preclusion of the offset of input VAT, including tax paid on importation. I'll allow my colleague Charles to speak to our second proposal. Thank you.
Thanks, Marlene. So, Chair, the second proposal, which forms the crux of the matter in this presentation, is for the law to expressly capture offset of overpaid tax under Section 47(1) of the Tax Procedures Act against import VAT. So a reading of Section 47(1), as my able colleagues have pointed out, is that it covers offset against future tax liabilities as well as historical tax liabilities. And if you look at the term future tax liabilities, from where we sit, on behalf of Shell and Vivo lubricants, we strongly believe that future tax liability would also cover import VAT that is payable at customs at a future date. However, Chair, the issue that then comes with it is the fact that this particular section has been the subject of divergent interpretations. And while some quarters will believe that import VAT is specifically covered, other quarters do not believe so. And so we seek the intervention of this committee to amend the law at section 47 so that it explicitly defines the term future tax liabilities to mean all taxes imposed and payable under tax law, including value-added tax payable on importation of taxable goods. And Chair, we believe this particular proposal to amend section 47 will go a long way in not only sorting out the issue of interpretation, but also making it clear for all stakeholders that the offset mechanism should apply to all taxes without exclusion that are imposed under tax law, domestic tax law for that matter, and in this case, domestic law, tax law that is in question is the value-added tax, because the Value-Added Tax Act under Section 5.1 imposes VAT on the importation of taxable goods. So from where we sit, we seek that clarification through a change in the law. A lot of the rationale around it has been covered comprehensively by the team that has spoken to it, starting with Shell and Vivo lubricants in terms of the impact that refunds is causing to them from a cash flow perspective, and the fact that, for one single entity, we're looking at the possibility of incurring additional financial costs going up to around 260 million shillings in a year. And the fact that the business, given that its operations predominantly will involve exports, then it would mean that this particular refund mechanism would only continue to accrue future refunds in the future, meaning that going forward then we are likely to, in fact, even have additional financial costs relating to just financing the working capital of the business. I would wish to just hand it over to my colleague for maybe further submissions on the same.
Thank you, Charles. Thanks, Maureen. So, Chair, I think in summary, we only have two proposals. The proposal is to delete clause 50A that is seeking to remove input VAT from section 47 of the Tax Procedures Act. And the other proposal, Chair, is just to clarify what future tax liability is for avoidance of any doubt. And I know, Chair, you may ask the question as to why then Shell and Vivo are not able to utilize overpayment against the other taxes that have already been provided. And the answer to that, Chair, is that while they do pay the other taxes, including pay-as-you-earn, the tax is not enough to offset against the input, or rather the overpaid tax that they have arising from these zero-rated sales. And Chair, as you may already know, the allocation per taxpayer for reward for VAT, I think it's around 30 million Kenya shillings per month. So that means that if you're accumulating your refund, at a higher rate than the 30 million, you're likely then to be in a perpetual credit. Those are our submissions, Chair. I don't know, Genesio, maybe you can add a few points before we take it back to the Chair for any questions.
Not adding anything, Chair, just clarifying crystal clear your question that you asked. It's true we actually enjoy offset of VAT, withholding tax, installment tax, and all that. But the company, blending of lubricants, raw materials are 100% important. Therefore, and unfortunately, the input VAT from the imported raw materials is not allowed for offset. The company exports 52%. In other words, again, is not able to get enough output VAT from the local sales. And basically, that is the reason why we are struggling. Thank you.
CPA Ruto, you have a concern?
Thank you so much, Chair. Really followed keenly the presentation by Shell and Vivo. It caught my attention, the aspect that you are owed 1.3 billion shillings in terms of VAT refunds. The discussion around here, which I've listened to many presenters, is the aspect of saying we would rather not move from zero-rated to exempt. From the experience of your industry, what, if given opportunity, what would you say about that, moving from zero-rated? Because it's a result of zero-rated products that you're dealing with, I'm sure, isn't it? The result why you are here on this 1.3 as a result of the products that are zero-rated among the lines of products that are being traded by Vivo. Of course, I knew fuel now, this is vatable, loops are vatable. These particular supplies, I don't know specifically what cost these particular claims that you're being owed, and you feel the business is stressed. And then your general view, where the commissioner is seeking that we move some of this category of products from the second schedule to first schedule, so that they can be exempt. And or finally, would we even go to standardize so that we absorb this? What is your view on that?
Thanks for the question. I'll
Hold on, Honorable Paul.
Yeah, Chair, mine would be almost the same as I had earlier asked. The question is that when you talk about 1.3 billion, it's really a lot of money that would cripple the industry. What I'm asking is that when you have engagements with the KRA, what do they exactly tell you? What agreement did you agree on? Has it gone just like that, or they still hope, or how are you continuing? Thank you. Because you'll be actually, it's like you'll be digging a hole all through. Thank you.
Chair, I thought Paulo will declare his interest because he's in the sector, and whether this 1.3 would affect him indirectly.
Yes, actually, I would declare that we are partners with Vivo. I have some interest there, but those are separate interests. And I'm even wondering now whether it is going to affect all the dealers, because are you going to push that to the retailers and your dealers? Because nowadays, the retailers pay you direct, and you're supposed to refund them. So are you also not refunding the retailers? Or you're refunding, then the debt remains on you? Thank you.
Over to you, Fred. Proceed.
Thanks for the questions. I think I'll take the first one, then I'll ask Genesio maybe to respond to the second one. So in terms of zero rating and exemption, I think the reason we get ourselves into this situation where we have refunds is because zero rating allows taxpayers to claim a credit for VAT suffered, whether suffered on local purchases or VAT suffered on importation. The reason zero rating is a preferred rate is because this VAT that is suffered on purchases, whether local or imported, those costs, that VAT does not become a cost to businesses. So they're able to claim it, as a credit. And in cases where they actually have an output tax or VAT on their supplies, they are then able to offset that credit against their VAT charged on the supplies they make. And these would be local supplies mainly. Now, where there is exportation, then it creates a situation where zero rating applies. And zero rating would then mean in every other instance, there will be excess VAT credit. And the law then allows a recovery of that. So the recovery of this VAT is basically entitling a taxpayer to get the money back, either through offset against output or through refunds. Now, if we move to exemption, what exemption would mean is that this VAT that is suffered on local purchases and importation of taxable goods becomes a cost to the business, yeah? And so what that would then mean is that, because that cost has to be factored into the pricing and everything, so the cost of the product, the final product, in this case lubricants for Shell and Vivo, is likely to become more expensive, yeah? And that would then pose other implications, including competitiveness of the product compared to perhaps products that are coming from outside that are complete in nature. And it also then impacts affordability of the product itself. So while exemption may create a situation where we do not seek refunds, it ultimately has other implications that must be considered. And mainly the ones that come to mind right now is, competitiveness of the product itself, maybe against other products that might be coming from outside. And you would also be looking at, affordability of the product. So zero rating still remains to be the preferred rate for VAT purposes when you're looking at the products that Shell and Vivo sells. So I hope that clarifies in terms of the exemption and zero rating.
Thank you so much. Just only one statement to what you have spoken to is that the competitiveness of our local production is actually at risk given the various imports that you're having from the region, and especially now that you're able to trade as Africa and the rest of the world. So what you have said is fundamental. So we'd want to keep it as zero rated for the sake of regional competitiveness. Getting to the question on...
maybe so that you finish, Chair, okay. I was just asking this one from the purview that the Cabinet Secretary is bringing out the issue of what we call tax expenditures that is increasingly rising. We are now at an estimate of around 600 billion annually, which is morally same as the budget deficit in the budgets, and that Cabinet Secretary is seeking ways of reducing tax expenditure. One of it, how would he take out this 1.3 billion that you are suffering even yourself as we are here now, you are complaining. On the other side, the resultant of this one, interest rates on your overdraft is shooting because your money is tied by KRA, and KRA are not in a position to process because of challenges on raising the requisite money. So you are struggling, though you're still praying that it remain there while you're suffering in your business. What is the trade-off level? So that you don't struggle, neither also we subject Commissioner of Revenue or Cabinet Secretary for National Treasury, who is mandated to raise money to move the country forward. That was the view I wanted to know. Thank you.
Thank you so much. I hear you, but element of competitiveness you can discuss more. I don't need to delve into that, but yes, we will have some struggles there in terms of the trade aspect when that comes to that. But basically, it means that we may be forced now, instead of blending locally, we start now importing, which again is not the preferable state for the nation. So it's give and take. But let me go to the second question about whether we are passing it to the retailers and to the customers. As a matter of fact, we have not been passing this cost to either the retailers or the consumers. The reason being, during our last engagement with yourselves at the committee in Mombasa, we left that place with a lot of hope, expectation, and we were up in the roof saying, we are going to get this refund, so we don't need to do anything. Out of that, we got to engagements with commissioners. We got an engagement with National Treasury separately. We got an engagement PS Treasury, CS Treasury, until we were told VAT on important raw materials does not qualify for offset, and therefore we cannot be. So depending on your decision today, that's now at a strategic level where the government now required to make a decision on what is it now we can be able to do. Is either we change the model, close our plant in Mombasa, start importing from the other plants that we have 4 other plants in Africa, starting importing from those plants to supply the 11 countries we supply from Kenya. because we can actually supply them from the rest of the world or the rest of Africa to Kenya. So those are the decisions that now are on the table for discussion. So we plead with you, Mr. Chair, kindly let's have input VAT from important raw materials covered in this offset system. And once that is done, we will celebrate, we'll be the most grateful people from this forum. Thank you very much, Chair.
I conclude.
Yeah, thank you, Chair. I think those are the submissions from my end. I hope we leave this meeting the way Genesio and the team left Mombasa. I think they were celebrating. I hope we can celebrate that you have had our submissions and you will consider them as we go along. Just two clarifications. So the kind of goods we are talking about here, the zero rating, we should take note that the zero rating is basically because of exportation, not zero rating of local products. So that one is very critical. And as you all know, globally, that is a practice. In terms of exportation of goods, they are always zero rated for some reason. And that is in line with our national tax policy and the medium-term revenue strategy. So I think those are our submissions, Chair. And also for record, by the way, as we talk about 1.3 billion in form of refund, the company also has a debt to the banks of equivalent to 1.6 billion. So you can actually see it's almost lending, it's almost borrowing to lend money to the government. We rest our case, Chair.
Thank you very much. That is now Vivo mask.
So thank you, Chair. So we'll take mask very, very quickly. So I'll allow my colleague Charles to give us a background of who mask is and the reason we're here. Then I'll take us through the specific proposals that we have.
Thanks, Fred. Thanks, Chair. So in terms of Mask Kenya is a shipping agent for Mask Line, which is a company headquartered in Denmark. Yeah, and the company then falls under the AP Mola Mask group of companies. So the company has been in Kenya since 1987 and has been appointed to act as a maritime agent for Mask Line in terms of just ensuring from a regulatory perspective, it's able to coordinate the business of the shipping line in Kenya. So the reason we're here, Chair, for Mask Kenya is because of a proposed amendment to Section 35 of the Income Tax Act. And Section 45, under the Finance Bill, there is a proposal to then introduce gains or profits which are chargeable to tax under Section 9(1), derived from the business of a ship owner or charterer to the withholding tax regime. So I'll just try and paint a picture of the compliance framework when you look at Section 9(1), and then I'll hand it over to my colleague to make our submissions on the same. So Section 9(1) seeks to tax freight income that is earned by a ship owner on income specifically that relates to the embarkment of either cargo or passengers onto vessels. And the current compliance framework is that the Kenya Revenue Authority has created a framework on iTax that allows taxpayers who are in the shipping sector to actually account for what we call freight tax. And from where we sit, a lot of the taxpayers, because we actually consult for a lot of them, have been complying with freight tax up to current. And basically what they've done is to identify their shipping agents as the persons responsible for declaration and accounting for freight tax on income under Section 9(1). And this is backed by Section 47(2) of the Income Tax Act that recognizes that the master of a ship is deemed to be the agent for purposes of collecting freight tax and remitting that to the Kenya Revenue Authority. And that section 47.2 also envisages a situation where other agents can be required to, or can be appointed to account for freight tax. So the current framework is that freight tax is being accounted for, and is being accounted for largely by the shipping agents on behalf of their principals. Currently in Kenya, based on data that is available from the Kenya Shipping Agents Association, we have around 45 shipping agents, and those shipping agents take care of freight tax. So the introduction of, the proposed introduction of withholding tax, or the move to then shift the compliance framework from a self-declaration framework, where the shipping agent actually accounts for tax on behalf of the shipping line, to a withholding tax one, is likely to cause a number of implications, which I will request my colleague Fred to just speak to.
So, Chair, on this specific change, I think it's also good to ask ourselves what the problem is, or what the spirit of the current proposal is. So when you look at Section 9.1 as expounded by my colleague, it basically puts the burden of freight tax, or rather imposes freight tax in Kenya at the rate of 2.5%. But when you read the law, number one, it doesn't provide the deadline. It doesn't say at what point should you limit that particular tax. And number two, it is also not very clear when you look at the Income Tax Act on who is supposed to remit that tax, although Section 47 of the Income Tax Act appears to put that burden on the agent. There is the risk that maybe the Revenue Authority does not have the muscle to go after the agents, because Section 47 is not abundantly clear in terms of who should account for that tax. And we believe the reason then why the drafters of the bill thought of bringing it within the ambit of Section 35 under withholding tax is to cure those two issues, because the moment you put it under Section 35, number one, you have already imposed a deadline of 5 working days within which you should deduct and limit the tax. And number two, you have already put that burden on the importer for them to be able to deduct that tax and limit to the government. What is the issue that we have with that proposal? And this is one of those proposals, Chair, that we are looking in terms of also supporting the government in terms of ensuring that there is no tax leakage. The moment you put this burden on the importer, as my colleague has mentioned, we only have 45 shipping agents. So in terms of enforcement and compliance, ensuring that there's compliance, the Revenue Authority is very much able to follow up with the 45 agents. Now, when you put it in Section 35, you're going to follow up with millions of importers in Kenya, some in the informal sector, which then means that the government may not be able to correct the revenue that they are looking at. So from where we sit, we think that it is still better for the self-assessment regime to continue, where you then put it very, very clearly under the law that the person who should account for this particular tax is a shipping agent. So based on that, Chair, we are proposing 2 amendments. So amendment number 1 is on the deadline. We are proposing an amendment under Section 9 of the Income Tax Act to basically say that this tax is due and payable by the 20th day of the following month. And number 2 is to have a proviso under Section 47 to specifically provide the legal framework for the agent to be appointed as the person who should account for this particular tax. And we believe if that is done, Chair, the government then will be able to protect revenue and will also reduce compliance burden on MASK and also MASK Service Line, which is an unresident company, because they would really want to ensure that they actually comply in Kenya, Chair.
Thank you very much. Are there concerns from our members? Secretary. So the concern is, you actually think that if this proposal passes as it is, KRA will collect less and the cost of tax transmission will be higher than it is now?
Yes, Chair, that is one of the major reasons.
All right, because now the proposal is to shift the tax burden from the shipping entity to the importers and require them
Yes.
to withhold. Okay.
Correct, Chair.
Fair point. I don't know. Do you have any officer from KRA here? No. I think it would be important to understand the thinking of KRA on this, because I think you make a very straightforward point. All right, thank you very much, Musk. Our next presenter is ICPAK.
Thank you very much, Chair, and good morning. Through you, Chair, I'll request my colleagues to join us in front here so that we can make the presentation.
Wahasibu wajongee mbele. Introduce yourself and take us through your submissions.
Thank you very much, Chair, and good morning, members, honorable members. Once again, my name is FCPA Robert Wariro, and I'm with Ichiban Tax and Business Advisory, but in this instance, I am leading the ICPAK delegation as Chairman of Public Finance Committee. And with me is my colleagues. Through you, Chair, we'll just have a quick introduction of the team so that you know who is before you today. Thank you.
Thank you, Chair. I'm FCPA Erastus Kwaka Omolo, Managing and Tax Partner of Crow, Erastus and Company, but a member of the Public Finance Committee of ICPAK. Thank you. Happy to be here.
Morning, shared members. My name is Hilary Ronami, Director of Public Policy and Research at the Institute. Thank you.
Thank you, Chair and members. My name is Elias Wahisi, Senior Manager, Public Policy at the Institute.
Thank you, Chair and members. Nancy Mora is my name, and Public Policy and Research. Thank you.
Thank you, Chair and honorable members. My name is Winnie Nkatha, Senior Officer in the Public Policy and Research.
Thank you, Chair, honorable members. My name is Tony Juma, Public Policy and Research. Thank you.
Thank you, Chair. My name is CBA Robert Mabea. I'm a partner, Mabea and Associate LLP, as well as a member of PFT, ICPAK. Thank you.
Morning, members. Mutito Dennis from the Managing Partner, the Nekinsa and Associates, member of PFT.
Robert Maina, Ernst & Young, but also a member of the Public Finance and Tax Committee, ICPAK. Thank you.
FCPA, you may proceed.
Thank you very much, Honorable Chair. So we have quite a lengthy presentation, but what we'll do, Chair, because it's been submitted to the committee in soft copy, we will just go through the highlights, and then we can have an engagement session. And allow me to just invite Hilary Onami to just give us a very quick overview of the background to the presentation. Hilary?
Thank you, Chair, and thank you, members. Just I think as a introductory bit, the Institute has taken note that the preparation of the Finance Bill 2025 has been developed at a background of a slowdown in global economy and even at the local economy. There has been projections of slowed economic development. And not only that the fiscal space has been shrinking domestically, as well as that the disposable income for the households and for individuals as well has been shrinking, given the measures that have been introduced since the last few years. And that even as we go into the medium-term, Chair, we take note that history has had it that at every pre-election, during, and post, generally the economic situation in the country has been on the dip. So given the hindsight of 3 or 4 electoral cycles in the past, we tend to think that the situations might not change significantly. We're also looking at the tax to GDP ratio vis-a-vis the projections that we are yet to attain the requisite target that we've already been set, either in the medium-term revenue strategy or even to achieve the 2030 aspirations, that our tax to GDP ratio continues to, while it was leading across East Africa, but the challenge has been that we are unable to sustain that tax to GDP ratio due to quite a number of factors. Chair, looking at also the revenue performance vis-a-vis the projections that have been, that year in, year out, I think the projections that have been indicated over the years, sorry, I'm now at page 3, that looking at the projections that currently, overall from the past 4 years, the growth, rather the carry performance or attainment has largely been, has not met the target as set in the budget. And we don't want to continuously keep repeating the same mistake because non-attainment of the revenue performance always calls for supplementary budgets and revision of estimates. And this has always caused us to go deep into public debt. And as you all are aware, that the situation currently is not quite favorable. So instead of legislating ourselves to trouble, we project that averagely, I think Kere has been doing an average of 10% year in growth. And maybe we could come down with that target to about 2.647 if you apply the 10% increase to the 2.4 that Kere met last year. As at last month, Chair and members, you aware that Kere only met 2.1 trillion, collected 2.1 trillion against the 2.7 target. That said, we also checked on the tax policy and the medium-term revenue strategy, and by and large, we take note that the objectives that were set under the MTRS has been, there has some increase towards, some tendency towards meeting the set targets under MTRS, but there are also quite a number of policy concerns that are still pending across all the tax heads, from VAT, income tax, and we had anticipated that maybe because the medium-term strategy was ending next year, we could see some traction towards, especially reviewing the tax rate, the VAT rate, as well as the corporate tax rate and the personal income tax band, just to mention but a few. Allow me to submit in the interest of time and invite, through your chair, to proceed. Thank you.
Thank you very much, Hilary. And Chair and honorable members, if you go to page 7 of that document, really we are looking at the policy imperatives of the Finance Bill 2025. And Chair, I think it's important that we give you your flowers, and that is acknowledging that you're operating in a very difficult environment, particularly if you look at the tax expenditure report. And if you actually go to page 8, that table on page 8 gives you a comparative of the tax expenditures as a percentage of GDP. As you can see, Kenya, this is 2023, you're talking about 3.38% of GDP in tax expenditures. Compare that with our immediate neighbors, Tanzania just about 1%, and Uganda at 1.44%. So clearly, very constrained fiscal space, and we do acknowledge that. We also do acknowledge the efforts to expand the tax base. I think that's a very noble effort, and I think it's important that we also acknowledge that the Finance Bill 2025 has moved away from an aggressive revenue-raising measure leaning And we're now looking at more administrative and perhaps tax-based expansion measures, which again is a good thing because we believe that everybody must pay their fair share of tax. Again, we also noticed that in the Finance Bill 2025, there's a deliberate move to try and, reduce compliance costs. We've seen that in terms of the tariff reductions. However, Chair, even as we give you your flowers, I think it's also important that we bring out the pain point, which is the tax policy predictability, and this is anchored in the national tax policy and the medium-term revenue strategy. And the example that we're citing there is that manufacture of locally manufactured mobile phones, they're currently zero-rated, and that was introduced in December 2024, but now there's a proposal to get them to the VAT exempt status. And so the challenge here is that investors are unable to have a long-term view and planning horizon because of this unstable tax policy predictability. So, Chair, our request as an institute is that we look into that. And with that, Chair, allow us to now then move on to page 9, which are the substantive proposals that we want to share with the committee. And allow me to invite my colleague, CPA Mabea, to just walk us through very, very quickly those proposals, income tax.
Thank you, Chair. I requested to go to page 9. And this is basically on the income tax. So the first item is on issues to do with the capping of the losses. That's carrying forward of the losses. The bill proposes to introduce 5-year cap on deductibility of tax losses. Currently, the law permits taxpayers to carry forward losses indefinitely. To be more practical, I will mention an industry like horticulture, whereby there's massive investment on the same. And then when we look at the lifespan of the greenhouses as such, like after every 5 years, there is a replacement of the same. We feel the 5-year proposal will not give a credit or a fair justice to the taxpayer who is in that business, for example. So as an institute, we are recommending that we have a proposal of 15 years with a provision that those losses arising from investment allowances are carried forward indefinitely. And then number 2, end losses carried forward as at 31st December 2024 will be considered as year 1. This is basically to assist the investor to utilize the investment allowance fully and to allow and not likely to be subjected to the 5 years proposal will be too short to recover the capital-intensive projects. Then we go to clause, item number 2, clause number 11. That section 18D of the Income Tax Act is amended in subsection 8 by deleting the word surrogate parent entity and substituting the words, therefore, the words to file a country-by-country report and notify the commissioner by the last day of reporting of financial year of that group in such a form as the commissioner may specify. The concern here is that the proposed amendment of section 18D, section 8, implies that the country-by-country reporting and notification shall be filed by the last day of the financial year of the group. This contradicts the provision of section 18D2, which requires filing of the country-by-country not later than the 12 months after the last day of reporting period. So our recommendation here is that to file a country-by-country report as prescribed in section 18D, subsection 2, and notify the commissioner by the last day of the reporting financial year. That of that group in such a form as the Commissioner may specify. So we believe that there's need to align those sections just to ensure that give an opportunity to a taxpayer to harmonize the reporting on the same with respect to the group. And then page 10, clause 15, that's item 3, clause 15, change of the financial year. We welcome the proposal, and the proposal here is that currently the Commissioner is required to respond to an application of change of the financial year ended within 6 months. The bill proposes that where the Commissioner fails to give a decision within 6 months from the date of application, the change is automatically deemed to have been accepted by the Commissioner. Our recommendation here is that where a valid application for change of the year end has been submitted by a taxpayer, the change shall be auto-approved on the tax system upon the lapse of the 6 months period. The challenge here could be that if this is not automated, there would be a possibility of extension of that 6 months, and even the filing by the taxpayer would be a big issue. Meaning, the same way the ITAX system is automated on penalties and interest, we also propose that this be done by ensuring immediately after 6 months, automatically there is that change of the financial year. Then item number 4, clause number 17, amend section 37 of the Income Tax Act. The bill proposes to add a new subsection 1A immediately after subsection 1 to read, an employer shall, before remitting the tax deductible under subsection 1, grant an employee or applicable deductions, reliefs, and exemptions provided under this act. The issue of concern here is that the bill requires that all leaves be deducted before computing all deducting pay as you earn. And our proposal or recommendation is relief should be deducted from the computed pay as you earn as it is currently. And to be more precise on this, for example, a person earning an income in a tax bracket of 30% band, the allowable relief deducted could have to be increased from 2,400 shillings to 8,000 per month. If it remained at 2,400, then the taxpayer is likely to pay more, meaning that there's a difference between when let's say, for example, the gross salary, and then you deduct the reliefs before subjecting to tax, there's a likelihood that you will likely to pay more tax on the same. But the current practice is that you compute the tax and then you provide the reliefs, which again will make the taxpayer to pay less on the same. So I think the issue is the wording. And then item number 5 is a proposal that will be a new section under 18F, advanced pricing agreements, that's APS, for non-residents. We recommend that this provision, with an implementation framework to ensure a provision effectively promotes tax certainty and minimizes disputes, it is essential to supplement the regulations with clear implementation guidelines, institutional support, and defined timelines. This approach could help transform the APA framework from a legal formality into a practical, reliable tool for both taxpayers and the tax authority. And our recommended direct impact is that it will align with the regional practices, promote tax certainty. If implemented, Kenya could join regional counterparts such as Tanzania, Uganda, and Rwanda, which already have provision for advanced pricing agreements in their tax laws. However, regional experience shows that only a limited number of APS have been finalized so far. largely due to administrative capacity constraints and unclear procedures and limited interest from the taxpayers on the same. So the purpose of APA is to address the issues or emerging tax issues from transfer price policies. And then that's why we are proposing there should be a framework introduced just to ensure that there is a realignment on the same. Item number 6, that's page 11. Let's cross to number 19, amend section 52B on the final return with self-assessment. The bill proposes a deletion of section 52B4 and replaces it with the new proposal to read, every company liable to tax under this act shall also include with the self-assessment and a return of the income, an assessment and a return of any dividend distributed out of the untaxed profits or gains, such due with respect to such tax year, and the tax so calculated shall be payable at the due date for self-assessment. This proposal lacks a time frame, and we are proposing that to encourage tax compliance and efficient administration of the withholding tax on dividends, provide a grace period each, for example, 30 days after the self-assessment or filing of the return. I guess, for example, this will allow, the likely impact is this will help the taxpayer to plan for and organize himself or herself in terms of cash flow, especially penalties and interest could start to accrue immediately. Just a practical example is where you file the tax return and propose bonuses either for staff or directors on the same. And then again, even declare the dividend for the shareholders on the same. So at that particular time is when maybe the accounts will be done after close of the financial year, 6 months. You're making almost the last month of filing of the return. So at that particular time, there could be issues to do with the cash flow. So we are proposing if you can give at least even 30 days to align the taxpayer for cash flow purposes and compliance. Item number 7, clause 26A, extension of approval period for income tax exemption application. Sorry, FCPA. Sorry, I hand over to my FCPA Kwaka to continue from there. Thank you.
Thank you, Chair. Number 7 is regarding the time period that was agreed in, with this committee in Naivasha many years ago. And it was that tax exemption applications will be considered within 60 days. What the law did not envisage that time is that it will never happen. And of course, experience has shown, Chair, that KRA, in fact, does not honor the law with regard to the 60 days. So there is this provision and, of course, a suggestion to increase the days to 90, which is not bad, Chair. But we need to add a deeming provision, which then states that within those 60 days or 90 days, whatever your team will agree to, there needs to be a provision that covers the would-be taxpayer. One of them is to say that the validity of the previous exemption will remain, will be deemed to be still alive until the time. And if after 90 days it is not dealt with, then again there will be a continuation or a deeming that in fact the exemption has been granted. And Chair, the Institute proposes to provide a proposed wording to this particular clause by the close of business today, so that those sentiments can be taken on board, just to create certainty, Chair, and also not to create a vacuum in the law, which then will make people to start fighting for no reason, just to remove that kind of possible animosity. That is number 7. Then I go to number 8, Chair. Again, very fast, Mr. Chairman, regarding the taxation of real estate companies involved in the construction of residential houses. The provision here, the proposal here is to delete the provision that gave incentive to those engaged in the construction of houses. Our proposal, Chair, is that we retain it. And why do we say so, Chair? We say so because the bottom-up economic transformation agenda actually encourages the building of houses and, of course, the provision of housing. And once we remove the incentive, are we then going against beta? Are we going against the bottom-up economic transformation agenda? Number 2, Chair, retaining this incentive will, in fact, support the country's affordable housing agenda, which we are all looking for. And of course, Chair, I must add, this law has hardly taken root. And part of the things that we have been campaigning about is that we need to have a predictable tax environment. And by removing it after such a short time, what are we telling would-be investors?
Although I understand the passion in which you're making your points, but if we go at this rate, we will spend the whole day. So we may want to just go, this is what I'm recommending, and this is my reason. And
Thank you.
So that we can make progress.
Thank you, Chair. The next item, Chair, is about the proposal to remove tax incentives on local vehicle assemblers. Again, we plead that the incentive be retained, the 15% tax incentive be retained, because again, this thing has not seen the light of day. Again, predictability of our tax environment, Chair. Number 10. Number 10, the first part just summarizes what the current personal taxation arrangement is in terms of PAYE tables. But when we go to the next page, Chair, immediately after that, our new proposal is straightforward. We are proposing that the tax rate be reduced from wherever it is 35% downwards to 28%. Also, incentive, and that is the tax relief, be increased slightly, very small amount, to only 3,000 shillings. And that will give us a tax band of 10% to 28%. And it is not in a vacuum that we say so. It is to spur development, increase disposable income, realizing that we have had increases in terms of affordable housing, NSSF, and all these other things. And perhaps also it might sound better even from a political point of view, Chair. Now, corporate tax is the next item. And also here, Chair, we are proposing straightforward that the rate again be reduced to be in line with some of the countries that we can compare ourselves with, and we are proposing a rate of 27.2%, around there. The idea is to try and bring the corporate tax rate in line with personal tax. And on the other hand, Chair, is to say that if we leave the personal tax rate to be so high, it gives room and invites tax planning arrangements which may not be very good for all of us. It's a strategic thinking that we need to apply there, and also the idea that when we do that, we will encourage voluntary compliance, and when we do that, Chair, we are likely to collect more revenue for our country. Number 13, Chair.
Don't you think that your argument on payee and corporation tax then is contradictory? Because if you are recommending that those earning more than 800,000 to be pay payee at 35%, but corporate tax to reduce to 27.5%. And remember, corporate tax is you allow deductible expenses, and for pay as you earn, there is no any deduction for expenses allowed. Then you're going to have a very big disparity between. Therefore, if FCPA here will employ himself as a company and pay himself corporate tax rather than pay himself a salary.
Yes, Chair. You advised me not to bring in passion. Chair, you seem to have a passionometer. Thank you. Number 13, Chair, is deductibility of expenses not supported by E-teams. And this is a matter which is straightforward, Chair, because the provision in the Income Tax Act is that I pay tax on income minus expenditure. And when we talk of income, I'm talking of taxable income, and of course expenditure is allowable expenditure. Where we have this problem with E-teams, we are proposing that since the law was amended in 2023, that we move the start date to be 2026. And of course, we have explained there why we are proposing. And Chair, we have given a proposed wording that could be employed if the committee feels that we have given a good suggestion in order to change that law and make it much more accommodative and good for the country. Number 14, Chair, is the whole issue of tax point on withholding tax. On withholding tax. The proposal that is there is that when you make accrual, then you immediately become liable to remit that money to Kenya Revenue Authority. And Chair, it is not correct, because when you make an accrual based on an invoice, many things can happen. One of them, the deal may fail. Number two, that particular thing may become a bad debt. Number three, the fee may get reduced, whatever it is which was subject to withholding tax. Number four or five, the invoice may not be paid this year, but be paid next year. And ITax is programmed in such a way that withholding tax is picked up in the year in which it is paid. What then will happen to the tax return of the individual concerned? Now, that allocation problem will also arise. And the truth is, I should pay withholding tax, of course, and do it promptly, but when I make the payment, not when it is an accrual in the books, which can suffer the fate of any of these things that I have already mentioned, Chair. Next, which is my last point, number 15, still on withholding tax, we have a requirement that withholding tax be paid within 5 days after deduction. And Chair, from practice as an auditor, the answer has been very simple. When I don't have the money, or when I don't feel like paying withholding tax, I hold it. And I pay it when I have the money. So this idea of saying within 5 days What it does is it makes people to hold invoices and only pay when they are able to pay. But when we have, if we can leave this rule under the old provisions, which says that by the 20th of the following month, the exchequer will be more sure of receiving money at that time, rather than allowing a field day for taxpayers to plan how and when they can pay. So this provision, Chair, needs to be cleaned up to go back to a fixed date for submission of withholding tax. Thank you, Chair. Back to my colleague.
Michael,
yes, CPA, you have an intervention.
Thank you so much, Chair. First of all, I'm looking at the presentation. Morally, most of them are proposals outside the provision of this, of the bill before us, because I'm trying to trace the clauses you are referring, but I cannot. But meanwhile, the two things you've said, the issue of commencement date for Section 16. I'm trying to understand exactly what is the motivation or what is the justification other than the presumption that there could be some expenses that they are genuine, but they will be locked out. So you and I, we are accountants, and you know the principles of, the two principles, accrual concept and margin concept. I don't know how will this one differentiate from that, because at the year of income, which is already done, so the expenditure was incurred. And you understand even taxation will appreciate the rule of the accrual concept when you are determining the tax liability. Likewise also at the point of raising the income, so the expenditure are there. So I wanted to know this one. I'm trying to figure out, could there be any other reason over and above this one? Why am I saying that? There is something before us. You are aware the VAT amendment are before us that is seeking to vary the effective date of this particular tax expenditure from what tax amendment laws had given to January, and someone is requesting the effective date to be December 2024. It is still yet to be discussed. I'm trying to relate to this one. What could be further justification on this one? Because only on the issue of they could be genuine, I don't find it holding waters, because as an accountant, I want to believe the tax expert also, who happens, most of them being accountants, will appreciate that the issue of accrual has already been captured, so that anything that happened thereafter, it goes with expenditure and the income of that period. Lastly is the issue of withholding tax payment. Finance Bill 2023 had sought that withholding be paid within 24 hours. Last year, during Finance Bill 2024 and tax amendment laws, we all agreed together with you stakeholders that 24 hours was not reasonable. You know, it was a bit stressing. We agreed 5 working days, not even weekends, including weekends. Now again, under your proposal, you are saying further again, no, let's go back to where we were. And we understand the problems that we found ourselves, that the Commissioner found, he or herself, in, because of the traditional, the earlier days of the whole entire one man. So why are we shifting goals? When are we going to agree that even as a business community, we must also adjust ourselves and appreciate the fact that withholding tax is not your money, and there is no justification as to why you need to hold on the invoice. When you are paying that invoice, when you are honoring that invoice, that particular payment, you are paying all sum, because that is an obligation to you. This is a supplier to you. You are processing the payment, you are paying all sum. It's all that the maths at the end of it is that you separate through checkoff. You release the net to the receiver, release the taxes to the receiver, that is Commissioner of Taxes. So I don't understand this one being justification of lacing or imprudently handling your, it's not also good for clients and it's not good for business. Thank you.
Chair.
Thank you, Chair.
And Paul, you have an intervention?
Yes, Chair, maybe a rider on what CPA has just said. I'm not a CPA, so I may not use the right terminologies. But on this issue of withholding tax, the argument ideally was why even we agreed on 5 days was because of logistics. Otherwise, ideally, at the point of payment, there should be a departure of the money going on to taxation and your money. So by adding it to 5 days, I think it was reasonable enough, because it's actually supposed to be at the point of sale that departure should be. But another one, in clause 15, I just wanted also a better understanding on the issue of the change of financial year. When the commissioner does not respond, you said that where it does not respond, the taxpayer will be exempted from late tax filing. Is it that you want it to be exempted only for late filing, or do you want it to auto approve, so that I get it clear? And then lastly was on the issue, what I've also heard you say, based on this current law, most contributions are already deductible before calculating income, subject to payee. Are you now suggesting that we change the current treatment from deductions to tax relief? And as it stands, contributions such as SHIV, such as housing levy and post-retirement medical contributions, are already deductible. So what exactly are you wanting it to look like? Thank you.
Thank you, Chair. The first one, with regard to the date for submitting withholding tax, Chair, it was to help the country. It was out of a very, very serious patriotic feeling, because in the field, we have seen what people are doing, Chair. They then say, oh, 5 days, I'll hold until. And that is why we were proposing, out of patriotism, not out of a desire to deny revenue or delay revenue, but out of patriotism, that we find a point of convergence that everybody must submit. It was just because of that. And I emphasized the element of patriotism and a desire to see the nation grow, arising from experiences we have seen in the field as auditors. Number two, about accrual, Chair, it is that when I accrue an invoice from a supplier that would ordinarily be subject to withholding tax, that accrual does not mean I'm going to make the payment. It doesn't mean the other party will in fact agree or accept even any other deal around it, because the withholding tax is on me, the payer, the one paying the bill. So we were saying that if we do not have a way of controlling that, and one, that invoice gets canceled, what do? The deal fails, and the matter is withdrawn. That invoice later on gets reduced through credit notes, or there is even a delay in paying that invoice to the following year. What does it mean? It just means that I will be forced to make contribution to the exchequer on something that may in fact even fail completely. Then I will have to ask for that money back. So that is the mischief we're trying to achieve in suggesting that let us retain withholding tax to be due to the exchequer, KRA for that matter, at the point at which we make payment. With regard to the area of exemption, Chair, that refers to organizations, non-profit organizations in particular, that are allowed tax exemption. It was not referring to personal taxes, just to those ones. And we were saying that if I had an exemption certificate which expired today, and 3 months later is when my application for exemption is considered, what happens to this period of 90 days between today and the time I get the feedback? It can be a rejection, it can even be an approval. So that provision was just suggesting that we have a deeming provision which covers that vacuum, so that it is in the law and not left for us to be arguing with KRA about. At the moment, they are not doing very well with those exemption applications, Chair. But that is a subject for another day. Personal relief, Chair, we were talking about personal relief. At the moment, it's at 2,400 per month. We're just saying that we took it a little bit, just by 600 shillings, so that relief also becomes a little larger, and of course it will leave a little more money in the pockets of taxpayers, and that money will go back to the economy. Thank you.
Thank you. Let's make progress.
Thank you, Chair. I wish to respond on the issue of change of the financial year. Why we are proposing that in an event that the Commissioner is not able to respond within the 6 months period, as per the proposal, it's presumed that the change of the financial year automatically is deemed to be acceptable. This is an administrative issue that we are trying to address, in a sense that we have situations whereby, remember, the Commissioner is in charge of the ICPAK system or the tax system, so the taxpayer is not in a position to automatically file the tax return. He has to go through an administrative approval to be given that access. So the access period after the lapse of 6 months is what we are saying, that if there is in an event there are penalties, let's say the last day is today, the lapse of 6 months, and then tomorrow, if you go to the system, log into the system, you will not be able to access in terms of filing. That delay is what we are trying to address, of which the system automatically charges the penalties and interest that will accrue for non-filing of the same. So we are saying that those penalties that will accrue from non-filing to be exempted on the same, as well as if the system can be enhanced the same way the ICPAK system is enhanced to charge penalties and interest for non-payment of taxes, automatically the system updates itself to change of that financial year. So the two recommendations that we are bringing on the same. Clause 17, on the issue of which the bill proposes to add a new subsection 1A, immediately after subsection 1, to read an employer shall, before remitting the tax deductible under subsection 1, grant an employee or applicable deduction, reliefs, and exemption provided under this act. The impact of this is that unlike the current formula of computing pay as you earn, whereby you compute pay as you earn and then you allow the reliefs, personal leaves, the housing, and shift. On this case, the proposed bill proposes that you deduct the reliefs first before you calculate the pay as you earn. So the difference between the formulas used will amount to payment of more taxes if the same salary is subjected to tax. That's the difference, before and after. The current act provides that you provide reliefs after computing pay as you earn, but the proposal is that you give reliefs before you compute pay pay as you earn. That will give the difference in terms of tax payable, which will impact the employees on the same. Thank you.
Thank you. We will proceed to VAT, and now we will try to make it a bit faster. I take cognizance of the time. So our first proposal is in relation to a clause that we do have in the bill, clause 32A. Now, there's a proposed deletion of a clause that currently allows taxpayers to offset where they have overpaid withholding VAT credits. Now, taxpayers will have the option of seeking refunds, but what that means is that they will not have the option of offsetting. But I do take note of what the team that was here before us was addressing, so probably that is addressed from a tax procedures perspective. This might resolve the issue altogether, so I will not reiterate on that. Now, the second point is on page 20, clause 36A. There's a proposed deletion of paragraph 6.3 of the first schedule. And this is the provision that provides for exemption on materials that are supplied on the construction of specialized hospitals with a minimum bed capacity of 50. Now, I did hear the Honorable Ruto highlight the issue of the tax expenditure, and I do believe this is what the government is trying to cure. But I think it will be important that we look at the issue of tax expenditure together with other economic aspects. For instance, I think Kenya at the moment in the region, East African region, a lot of people come to the country seeking medical attention because of we have better facilities than other countries, our neighboring countries. And I think this one was one of those provisions that would have enabled the country to become a key medical tourism hub in the region. And that's why we do propose that you retain it. And as a way of encouraging probably the country becoming a major hub from a medical tourism, like we've seen in other countries such as Dubai. So that's our proposal. The next one is on Honorable Chair, is clause 36K. Again, it's another deletion of an exemption that is available. And this is specifically to those who are developing solar and wind energy. We have seen a lot of interest in this area. We do know Kenya is a leader in renewable energy, getting more than 80% of our energy from renewable sources. But we still do have gaps. We are importing quite a bit of power from Ethiopia and other neighboring countries. So our player is here, one, from a perspective of ensuring that we are promoting renewable energy as a good source of energy. Then we retain this one. And what it does as well, as much as there's a tax expenditure element, is that the more you have people consuming this kind of power, then we also reduce our bill in terms of importing petroleum products. I'll move next. In terms of page 21, there's a proposal to delete another exemption there. This is for raw materials that are used to manufacture passenger motor vehicles, as well as locally manufactured passenger motor vehicles. So in this case, we are looking at, from a manufacturing sector perspective, we do know this sector has been facing a lot of challenges, currently contributing at about 7% of the GDP, while we do have a target of 15%. This has been there for many years. We are trying to work towards this, but we do agree in this country, if you look at what's happening, for instance, Isuzu, they have a huge plant here. They are manufacturing a lot of buses, and you can also see them in our roads. So this is an area that I think is key in encouraging the manufacturing sector and ensuring that we actually ensure a growth as opposed to just declining like what has been happening. And we know if we do away with the exemptions, the cost of these vehicles go up. So currently people import a lot of vehicles from Japan and other countries, UK and all that, because the cost of locally manufactured vehicles is still very high. So doing this will actually even make it even more punitive to acquire locally manufactured vehicles. Then the next one is point number 20, and we've brought together a number of, again, proposed exemptions, deletion of exemptions. One on supply of electric bicycles, supply of solar and lithium batteries, supply of electric buses. Now, here our concern is on the predictability and the consistency of the VAT status of these items. Just the other day, we saw that there's a bit of growth, and we have seen a bit of players who have actually set up plants in Kenya to assemble these vehicles. For instance, the buses that we are seeing on our roads, we are now seeing other more, vehicles that are using electricity as a source of power coming in our roads. We have the issue of electric bicycles. We are seeing a lot of people delivering food using the app that we have, using electric bicycles. So it's still a very new phenomenon in this country, and it is in the best interest to give them time to grow to a level where we actually they're able to compete with the traditional industries. And what this does is that in the long term, if we do have more and more buses and people using, electric vehicles, then we have a reduction in our consumption of petroleum products. And we do know that is our heaviest burden in terms of the foreign exchange, usage in this country. We do spend a lot when we're importing this. So if we encourage this industry and we have more people using this, then the ripple effect is that we do have a benefit from that perspective. Then the next point is on page 2022, point number 21. So this is again linked with the direct tax proposals on the VAT rate. What we say, we noted that in the medium-term revenue strategy, there's a proposal to reduce the rate from the current 16%, to 14%, eventually. And we are also aware there are studies that have been taking place on this matter. So our ask is the committee to consider and to also put the National Treasury to task to explain the status of those studies so that we see a reduction of the rate to 15% and eventually to 14%, which would be a very good incentive and encourage consumption in the economy. Then the next point is on withholding VAT. Now, here, there are two ways we are looking at this. The issue of e-teams, because now we have e-teams, which is every taxpayer who is registered should actually have an e-teams device or at least be registered for e-teams. KRA has 100% visibility of all VAT registered taxpayers in this country. They also have visibility of all the invoices that you raise. So the whole spirit, because withholding VAT, one of the things that was meant to, to cure was people were hiding. There was no way of getting to know people who are actually charging VAT. People who charge VAT, get the money and pocket. But now you can't do that because there's a system that is able to identify that. So the question first is, do we really need withholding VAT in the first place with the e-teams system where KRA has 100% visibility? Maybe not. And that is our ask, number one, that you consider repealing the entire requirement of withholding VAT because it's just an additional burden, which is not necessary at the moment because of the visibility. If not that, we're asking that you actually allow taxpayers, because there are those taxpayers who have perpetual withholding VAT credits to actually seek to seek for an exemption from that, so that we actually ensure that they safeguard their cash flow. Then I'll move to the next point in the interest of time. Then there's a provision, that is page 23, point number 23. This is on the general penalty that is available. What we have noted is at the moment we have a penalty of 1 million shillings, where there's no other penalty provided in the law. Now, this has been used a lot by KRA, and at times it's to the disadvantage of many taxpayers. So, for instance, if you think of the supermarkets, the quick restaurants that we have all over this town, what they do is that they'll just come and get a receipt from you. And if there was a delay in the submission of that, because it does happen, either because there was internet outage or there was a delay in all that, they will actually just check your submissions for the day, and they will tell you, we bought this, and we cannot identify this in what you have submitted. So, and you will be liable to the penalty of the 1 million. So it's actually being misused in the economy. So our proposal is that you reduce this to 100,000 because it still, becomes it still deters business from doing anything that is not in line with the law, but it doesn't overburden businesses and also, gives KRA a chance of just harassing taxpayers. And with that, I will get you to the last point and invite FCPA Kwaka to take you through the issue of VAT special table, which is also another menace. Thank you.
Honorable Chair and members, the issue of special table has been in the media. And the Honorable Chair is aware that last week it was a topical issue at the ICPAK 42nd conference in Mombasa. And what we are proposing is very simple. One, the issue of special table is an illegality. Number two, we are pointing to a previous judicial review decision which said that it was not valid. Number three element, Chair, is that the fact that somebody is doing nil returns is not a crime to do a nil return. It is not a crime under the Income Tax Act, Cap 470, and it is not a crime under any other law. So when people are being taken through this special table element, which prevents them from doing business, we could actually be hurting ourselves. And Chair, we have the whole area of reverse invoicing, which is usable by KRA to partially resolve the issue of people who are buying goods and then being stopped from fulfilling their requirement under this special table thing. And we are asking and saying, as again, a matter of patriotism, Chair, that lots of young people are being affected, and we need to be sensitive to the environment involving young people. And of course, when people are stopped from doing business because of the special table, we are actually sabotaging revenue, Chair. We are sabotaging revenue. And what else should we say? Because when I am prevented from complying, and on the other hand, I am required to comply, it therefore means that there is something we are missing, because we are reducing revenue that we should be generating in the economy. And Chair, I wanted to mention that ICPAK will be providing a proposed wording and amendment to the PTA Act to be able to accommodate that thinking for your kind consideration and also checking with any other body that needs to check. Thank you.
Thank you, Honorable Chair.
I did make a commitment to you at ICPAK last week that I'll follow up with the Kenya Revenue Authority. So we had a meeting with the Commissioner General on, was it on Saturday? Yes, on Saturday. And we did raise the issue of a special table. And there was commitment from the authority side to gazette regulations on how that process is being undertaken, and also do more taxpayer education about the issue of VAT. However, taking the performance of VAT, apart from corporation tax, VAT is the only other vote head that grew by more than 10%, comparing the same period this year and the same period the previous year. And so the challenge with this special table is that it is bringing unnecessary burden to some already compliant taxpayers. However, numbers are showing that they actually have helped to track missing traders and who have not been filing VAT returns and not paying the equal share of VAT. So the question is about how do we balance between now burdening already those that are compliant and ensuring that all the others that should be paying VAT and are not paying are actually brought to be able to pay.
Correct, Chair. And also to try and mitigate the point that some people involved with the system have used special table for rent-seeking behavior. And that is something that we are bold enough to say. And so instead of preventing revenue from coming to the exchequer, why don't we clean up this thing? And thank you, Chair, for taking it up. You did promise it last week, and I'm happy you have done so.
Thank you, Chair and honorable members. And just to perhaps, as we bring that argument to a close, perhaps the Chair would be aware that on 23rd of May, that is last week, there's a petition that was filed in the High Court challenging this particular issue. So it's really a pain point that we hope will be addressed sooner rather than later. So, Chair, allow me to just quickly go through the excess duty proposals, and that's item number 25 on the clause 38. And really, Chair, what we're asking here is just a cleanup or a clarification, because the Business Laws Amendment Act 2024 included non-deposit-taking microfinance institutions under the remit of the Central Bank of Kenya. So we are saying the current proposal in the Finance Bill 2025 seems to have left out that segment of the MFIs. So perhaps that could be included. And then the next one, number 26, is around locally manufactured plastics. Really, the Chair, what we're asking here is, yes, we are okay in maintaining the excess duty on imported plastic items, but could we have a reprieve for locally manufactured ones? Because we are going to create more jobs, we're going to cushion consumers from higher prices, and as well protect our forex. And of course, Chair, we are alive to the geopolitical developments and even the proposal from the US to impose a 5% excise duty on remittances. So certainly it's worth protecting that forex. The next one, Honorable Chair, is a proposal to bring in a relief on excise duty. And this is specifically for packaging materials, because that has been a thorn in the flesh as far as excise duty is concerned. And Chair, I guess to bring this very close to home is over the last 1 year, we've had contradicting decisions from the Tax Appeals Tribunal. In one matter, biased of East Africa, the tribunal ruled that packaging materials do not qualify for excess duty relief. And then in the other matter, London Distillers, they ruled that it is. So as we can see, there's a big problem from a consistency of application of the law perspective. But I think what is sad, Honorable Chair, is that the one entity that lost the case is now no longer manufacturing in Kenya. With that, jobs gone, corporation tax gone, PAYE gone. And so in keeping with the principle of final consumers should pay the excess duty, we request that that clause 14.1 or section 14.1 of the Excess Duty Act be amended to include packaging materials as well. And so, Chair, those really were the key proposals from an excess duty perspective. I'll just invite my colleague, CPA Dennis, to very quickly take us through the Tax Procedures Act as we wrap up.
Chair, we start with the clause 43, that is section 23A, the issue of electronic tax invoices. The bill proposes exempting certain institutions, that is under certain services, that is salaries, imports, and interest. We hope that this thing will also include sectors like tea, coffee, as well as dairy products, and maybe we can cap them to a turnover of below 5 million. The next, my next proposal is on 30. The issue of section 31. On this one, this is a welcome move, and I think it reflects the needs and voices of the taxpayer. That the issue of the other law does not require the Commission to give reasons when issuing an amended assessment, but now he'll have to give a reason. So that's a welcome move. And we now go to clause 45, the issue of section 39 on penalty for failure to deduct or withhold tax. So on this one, it's also a welcome move in such that the tax might be paid somewhere else, and before the taxpayer was liable to pay the fine. The other one is on the issue of section 47B. The proposal is that the refund should be moved from the current 90 days to 120. We hope that to be retained, our proposal should be retained to the 90 days. I now invite my colleague, FCPA, to take us through section 59.
Yeah, thank you, Chair. Chair, the Finance Bill 2025 has got a clause 47M4, which seeks to amend section 4214E of the Tax Procedures Act. And really, this is around agency notices. And Chair, the reason why this is a matter of concern for taxpayers is because over the last 4 years, we've had 2 attempts to bring in the rules of pay-to-play, meaning before you appeal, you have to pay something to Revenue Authority, which makes access to justice quite a challenge. And so Section 4214E is the one that currently provides that until your time to appeal at a tribunal decision or a high court decision lapses, the commissioner cannot issue an agency notice. So by deleting that, it means that immediately I lose an appeal at the Tax Appeals Tribunal, then the commissioner can issue the agency notice, which is a big problem because then it essentially cripples the taxpayer's business and also does not engender an environment where people can alternative dispute resolve their matters or ADR their matters, mediate. And in any event, the High Court has been quite clear on the doctrine of exhaustion of remedies before imposition of these agency notices. So our request is that clause 47M4 of the Finance Bill 2025 be deleted. And then, very briefly, in terms of paragraph 33 in your document around section 59A amendments on data management reporting system, I think that has been very well brought out by the colleagues before us, Bolt. And so, really, the issue is, do we need trade secret data to administer tax? And our view is, no, we do not.
Chair, we now move to number 35, the issue of section 3A. In this one, it's a welcome move in where that the committee was able to identify what a small business entails. In this one, I think you came up with a system that requires what you call the reverse invoicing, where the buyer will account for, the buyer now will be the one issuing the items. We move to 35, 36, FCPA.
So, okay, thank you. So the whole issue here is what we are discussing earlier around reasonable cost for failure to comply, which will lead to ambiguity and enforcement in post.
Let's go back to this deletion of E. Clause 47M5.
4. Oh, sorry, 5.
Yes.
5.
So they're proposing to, in subsection 14, by deleting paragraph E. So section 42 of the Tax Procedures Act is the one that provides for power to collect tax from person owing money to a taxpayer. So 14, the commissioner shall not issue a notice under this section unless E, the taxpayer has not appealed against an assessment specified in a decision of the tribunal court. So the deletion of this means that you will still be required to pay even when you are undergoing appeal at the tribunal. So that's what you're saying, to take away the right to, okay, fair point. Proceed.
So,
just wondering why they would want to do, trying to think like them, why they would want to do that. But anyway, proceed.
Chair, I don't hold brief for KRA, but I think it really is just collecting revenues in advance. And I think at a practical level, because we are all practitioners here, at a practical level, what generally happens is that they will issue an agency notice, then I have to come and negotiate with them how much to pay. And that has happened in practice. And actually what the High Court does is once you appeal, the High Court will say, okay guys, let us agree on a reasonable amount so that the commissioner is also secured in terms of their taxes, and the taxpayer is also able to continue their business. So we're asking, let the status quo remain, because that has already been resolved by the High Court.
I'm reminded by our Director Legal that this provision comes every year. And we have made the same decision every year, so you don't have to be worried about the decision that will be made on this particular clause. Proceed.
Thank you very much, Honorable Chair. So yeah, what we're just proposing here is, in terms of clause 36, is to clarify what reasonable cause is, so that then we reduce disputes around the penalties, especially for failing to withhold or remit the tax that has been withheld.
We now move to the new profession on section 87. On this one, the current penalty for an individual has been 10,000. And our proposal is that that provision should be, the fine of 10,000 should be moved to 50,000. And you imagine where someone, let's say an individual, has a turnover of 200 million, and a company has a turnover of, let's say, 1 million. The issue of a company being fined 100,000, and the person, individual, being fined 10,000, has a lot of has been bringing a lot of issues in where people are now moving from company to trading as individual. So our suggestion was that the fine be moved from 10,000 to 50,000. The other one is section 109, the issue of power of the commissioner to compound offenses. The current provision gives power to the commissioner committee when compounded tax offenses. This contradicts the issue of Article 47 and 50. So on this one, we propose deletion of section 109(3)(e) to ensure fair tax administration. Over to you. I think we are through with our submission.
And finally, Chair, very, very final point is with regard to an element which is not in the Finance Bill 2025, but it is a proposal to increase revenue to the Exchequer. And this is with regard, Chair, to the unclaimed financial assets, which we know at the moment is over 8 billion shillings, which is invested. And our proposal is twofold. One, that section 45 and 48 looked together of the UFAA Act. One, to provide that those who get claims later be given interest on the earnings out of the monies that UFA will have earned from whatever. And we are proposing that it be at the average interbank rate so that there is no ambiguity about it. And then, Chair, that when those credits are given to unclaimed assets, cash, because unclaimed assets are, of course, don't bear anything, that withholding tax, which is a first and final tax, be levied on that money so that that money goes to the Exchequer to increase revenue to the Exchequer, to the country, and it will be good for all of us instead of that money not helping to develop the nation in that very special way. Thank you, Chair.
That's an interesting point. But then that means we'll have to amend the Unclaimed Financial Assets Act. But I'm wondering if the withholding tax can be amended. We can amend the Income Tax Act without necessarily having to amend the Unclaimed Financial Assets for that particular withholding tax.
Chair, that is why I mentioned section 45 of the Unclaimed Financial Assets Act and section 48 read together, that will need to be amended. And since all these fall under Treasury Chair, the beautiful thing is that the Minister for Finance has control over the two of them. So moving to amend the UFAA may not be too complicated, but let's get some revenue to develop the country, Chair, and increase our whatever trillion we need to collect each year.
Thank you. The only challenge is there has been a ruling by the courts that you cannot amend a different statute if it was not in the bill in the first place. So the amendment of the Income Tax Act to provide for that withholding can be done, but then amending the section 47, 48 of the Unclaimed Financial Assets will have to do another bill, which is something that is easy we can do.
Yeah.
So thank you very much. Honorable Chiforomondo, introduce yourself.
Thank you, Chair. My name is Chiforomodo Mangale, MP Lungalunga constituency, which is in Kwale County. I'm a member of this committee. Thank you.
Thank you very much for your very good presentation. Of course, it's always interesting to listen to submissions by ICPAK, cross-cutting across all different subjects. So we thank you very much. We wish you the best at the Institute. Congratulations to the new council members and the substituted committees. We wish you all the best and ensure you of our support and commitment. Thank you. Our next stakeholder is East Africa Devices Kenya Limited. I'm told East African Devices are not ready, so let's go to Ichiban Tax and Business Advisory LP. Introduce yourself and your team.
Thank you. Thank you very much, Honorable Chair, and good morning. Well, no, I think it's afternoon now. Good afternoon now. Once again, my name is FCPA Robert Warriero, and I'm joined by my colleagues from Ichiban Tax and Business Advisory, and I'll allow them to introduce themselves.
Thank you, Chair. Good morning, Chair. Good morning, honorable members. My name is Christine Deritu, Tax and Legal Advisor at Ichiban Tax.
Yes.
Thank you so much for that. My name is Mercy Wairimo. I'm the Communications Officer at Ichiban Tax and Business Advisory. Thank you.
Thank you, Chair. So really, we are here to present on one particular issue, and that is on the retention of paragraph 113 of the first schedule to the VAT Act, that's section A. And this is for Greenlight Planet Kenya Limited. And really, Chair, what we are saying here is we are requesting for a retention of that particular paragraph, which provides for VAT exemption on specialized equipment for the development and generation of solar and wind energy, which includes photovoltaic modules, DC chargers, DC inverters, batteries, upon recommendation by the Commissioner and by the Cabinet Secretary for matters responsible for energy. So the reason why we are requesting for this, retention, Honorable Chair, is because we think that it will support Kenya's broader economic goals in terms of job creation, revenue growth, and access to electricity. And so retaining these provisions is critical to sustaining jobs and government revenue. And as we shall show shortly, we estimate as a sector that increasing VAT on these items, because when you remove them from the VAT zero rating list, VAT exempt list, it means that they'll be subject to VAT, and that will cause a reduction of 15% in terms of jobs lost, which will then lead to loss of POE and corporate taxes, as well as negating the progress that we have made as a country towards electrification in this country. And for that, you'll remember that in 2013, the electrification rate, our access rate to electricity in 2013 was 29%, now stood at 75% by 2023. And of that 75%, 30 is actually from off-grid solar solutions. So it's an important contributor to access to electricity. And then I do note that, Honorable Chair, a lot of your members are from the areas that are served by the Kenya Off-Grid Solar Access Project, COSAP, which essentially is a World Bank funded project that tries to get access to electricity to these underserved and marginalized areas. And so we believe that that will also form part of the access to electricity. And so if you look at that table on page 1, what we are saying is that if we increase the VAT on these items, then immediately we'll see a loss of 1,450 jobs. And these jobs are especially in the marginalized areas, where we have people walking around and selling these products, people walking around and collecting the payments that are due. And that Honorable Chair, does not even include the downstream impacts. If I don't have electricity access, I can't charge my phone. That means that I will not use my bundles. That means that I will not call. If I am a Mama Boga who is selling groceries at the stage, it means that immediately it gets dark, then I have to go home because I don't have access to electricity to solar to power my solar lantern. And we could go on and on about the indirect impacts, which we think will have a negative impact. And so we are saying, when you consider all that in totality, there'll be loss of revenue, even in as much as government is trying to collect a bit of taxes, but there'll definitely be loss of revenue. And Chair, we've got to look at this in the context of the finance bill objectives of raising revenue, because then if you're going to have loss of revenue, what are we really doing here? And one of the reasons why we are saying that, Chair, is because if you go to page 2, you will see that indeed in Finance Act 2020, that was section 13A3 of Finance Act 2020, it deleted paragraph 45 of the first schedule, which provided these exemptions. And immediately there was a decline in the amount of sales, a decline in the number of jobs. And as a result of that, Finance Act 2021 actually reinstated that exemption by way of introducing paragraph 113, which is now what Finance Bill 2025 is seeking to remove. So we're saying that we have empirical evidence, and there's empirical evidence of what a removal of this exemption has done in the past, that is in 2020-2021 cycle.
But FCPA, you do know that there is a provision for, it's not just a deletion, you're saying provided that an exemption that had been approved pursuant to paragraph 112 before the deletion of paragraph 112 came into effect shall continue to apply until the 30th of June 2026. There is a transitional clause that's helping those entities that have this exemption to continue enjoying the exemption. So the jobs will remain because they're still going to enjoy the exemptions.
That's a fantastic observation, Chair. And I agree with you that there's a transitional provision. The only thing, Chair, is that these exemptions are on a consignment by consignment basis, which means if I have an exemption on this consignment that is coming, say today, 27th of May, then it's that consignment that is exempted. Anything that comes in July, once the law has changed, is no longer exempted because it does not enjoy a blanket exemption. And that's the reason why the transitional provision does not really help us. And like we said, Honorable Chair, the Kenya Off-Grid Solar Access Project, I looked at some of the members of your committee. If you look at Turkana, Baringo, the Vice Chair, his people are major beneficiaries from this.
Just as the Vice Chair is from Kericho, not Baringo. The Honorable CPA Langat is MP for Ainamoi. But you're making a valid point. Yes, proceed.
Excellent. Okay, thank you very much. This is the reason why we are saying please retain that clause 113 because there is direct benefit to the country in terms of job creation, in terms of electricity access, in terms of commerce, supporting commerce across the board, and more importantly, in terms of supporting Kenya's SDG goals as well as the better economic agenda. And so, Chairman, what we have done in the following pages, we've just provided some information in a graph format. And you will see, if you go to the third page, you will see the impact of the number of units sold and how many Kenyans are benefiting from this. And what you will note is that as of June, the first half of 2024, we actually had 30% of Kenyans accessing electricity via solar off-grid solutions. So it's important that we support that. And then the table down there shows what we were talking about. Turkana, Honorable John Ariko would probably note that 42% of the electricity connection in that county is actually from solar. Mandera, Honorable Umbulker, will also note that about 40% of that access is from solar. And you can see some of these counties like West Pokot, we've got 56% of electricity access being driven by solar. So it's quite important that we support that initiative, Honorable Chair. And on page 4, we again just demonstrate the impact of investing or allowing this sector to have a VAT exemption. As you can see, the jobs have grown 20,000 jobs between 2022 and 2023, simply as a result of having this VAT exemption. So in conclusion, Chair, our request is retain this provision so that we can support the sector. Thank you very much.
Thank you very much, FCPA, for your presentation on solar and wind power. Thank you very much. Your submissions are well received. So, honorable members and our stakeholders, we have 3 entities left: West African Devices Kenya Limited, Kenya Property Developers Association, and IATA. Are they here? IATA that is IATA. Kenya Property. So it being 1:24 p.m. There's Manda. I'm sorry, there's another called Manda. Yes. Could we break for lunch for 1 hour and then we resume at 2:30? With all fairness, our staff have been sitting the whole morning. And we will extend lunch invitation to yourself. So, karibuni, lunch will be served on first floor. So there has been a matter of, and I think this is for friends in the media, you may want to take this. The finance bill of 2025 is coming for first reading in the order paper this afternoon. And there has been question being asked why then public participation on the finance bill is happening, whereas the bill has not been read for the first time. I will, however, like to refer you to standing provisions of Standing Order 127, which reads in part, whereas the House by resolution ordered that should a published bill become due for first reading during the short or long recesses of the 4th session, the Speaker shall, upon determination that the bill is of priority, forthwith refer such a bill to the relevant committee for consideration pursuant to provisions Standing Order 127, commit of bills to committees and public participation report such facts to the House upon resumption and cause the bill to be read the first time as soon as it is practicable. So although the bill is being read for the first time this afternoon and we're doing public participation, we still were in line with our Standing Order 127 because the bill was published during recess period, and therefore it was important that public participation starts even before the bill is read for the first time. So there is no any anomaly in law in terms of our process. Thank you. So we go for lunch, meet at 2:30.
Okay, fine. Let's start with the boats. Introduce your
English. Thank you, Chair. Let us pray. Almighty God, who in your wisdom and goodness have appointed the offices of leaders and parliaments for the welfare of the society and the just government of the people, we beseech you to behold with your abundant favor us, your servants, whom you have been pleased to call to the performance of the important trust of this republic. Let your blessing descend upon us here assembled, and grant that we treat and consider all matters that shall come under our deliberation in so just and faithful a manner as to promote your honor and glory, and to advance the peace, prosperity, and welfare of our country and of those whose interest you have committed to our church. Amen.
Thank you. Good afternoon, our stakeholders. I'd like to introduce two members of the Committee of Finance and National Planning, starting with Dr. Ariko.
Yeah, thank you, Chair. Good afternoon, Dr. Rico John Ahmad, Member of Parliament for Turkana South, member of this committee.
Chair, my name is Chief Oromodo Mangale, MP Lungalunga constituency, a member of Finance and National Planning. Thank you.
Thank you, Chair and our stakeholders. My name is Paul Kibichi Biego, Member of Parliament, Chesume constituency, that's in Nandi County, and I'm a member of this committee. Thank you.
I'm Bonnie David, Member of Parliament, Kitui Rural, member of this committee.
Director on behalf of Secretariat.
Good afternoon. I'm Jennifer Ndeto, Deputy Director, Legal Services.
Thank you. CPA Kuria Kimani, MP for More, and the chairperson of the committee. So East African Device Association of Kenya, take us through its commissions.
Thank you, Chair, and good afternoon to the members. I will start by introducing the team that we have come with from IDAC. My name is Johnston Kamunde. I'm the CFO in IDAC.
My name is Cora Zanongoro, PwC, presenting IDAC.
Good morning. Good afternoon. My name is Karanja Gishiri. I sit on, I'm a board committee member at IDAC. Thank you.
Good afternoon. My name is Mera Janai, also a member of PwC with IDAC.
Thank you very much. And through the chair, I'll quickly take us through the presentations that we have from IDAC regarding the subject matter that we have on the table. That is the legislative proposals that we have under the Finance Bill 2025, presenting to you, honorable members. I will start quickly by introducing, for the sake, a brief introduction for the sake of the members to understand who IDAC are. IDAC is an assembly factory that was launched in 2023, October 2023, to assemble devices, that is smartphones or mobile phones and smart devices within the locality of Kenya. We are located in Athi River, Grade 5. We have a number of establishments there. We've invested over $5 million for us to get to where we are now. Basically, we have operated for 1.5 plus years since we incorporated, or since when the President of the Republic of Kenya launched the factory. We have so far been able to employ over 750 employees who come in the various shifts that we have in our production process, and we have been able to date to produce or to assemble over 1.4 million devices in Kenya, which we have been able to take to the market. Of course, for those of us who have been able to pass through various outlets, particularly of carriers like Safaricom, anywhere you find a neon brand of phone, that neon brand is actually assembled in Kenya fully. There is no single neon brand that is coming from outside as we are talking. IDAC, being a young company, has achieved much, and one of our key achievements so far, first of all, in June last year, around June last year, when KRA was giving their annual awards, we were awarded top taxpayer on the non-fuel importers, which was a one-off. That shows that we are committed to the journey to partner with the government, both in compliance and meeting our obligations. We have also supported various government activities, including the CSP's program that the government was running in the Ministry of Health, and we are currently also supporting the SHA process by supplying the locally assembled tablets for purposes of enabling digital administration of the health sector. I will quickly take you through what we perceive around the unlocking of digital empowered economy through the mobile phones in Kenya. As you may know, the digital economy is the cornerstone of this century and probably the future in most of the economies, and it is very useful in transforming how all of us work. Today we were very impressed when we came with a box of printouts out there, and we were told that we don't need to come with them. So we actually said that this is the way to go, and we believe that this is what we are here as a company to support the whole of the economy to do, to ensure that they move digital and do their work with ease, and they become more connected, and they consume whatever they are consumed through the digital world. We believe that the digital world, the transformation is driven by increasing the penetration of internet and mobile devices and other smart devices and other digital innovations within the economy. And we strongly believe that a young economy like Kenya needs these innovations, both in the key sectors that particularly our government is focusing on. And that's why we are there to support these kind of initiatives. We believe we look at the whole of African continent, the sub-Saharan Africa. We noticed that the penetration so far has gone to 46%, and by 2024, of course, and smartphone adoption has reached 54%. This has been increasing due to the foreign cost of devices in the various locations in different countries, and this is a good thing. And most of this foreign of device cost is more influenced by the partnerships that we have with various governments in supporting through incentives the local industries. We believe that this partnership is in line with our local of our country, particularly within the fourth medium-term strategy paper that highlights that increased access to smartphones and mobile broadband is essential for delivering digital government services and expanding e-commerce and enhancing financial inclusion, especially in underserved rural areas. And I am sure we have seen that as we continue to penetrate the rural areas, the economies of those areas are also improving. The income, the disposable incomes of those people are also improving as they start accessing more than what they used to access. And they are becoming more informed, even as they access government services and they know where to go, reaching those services from where they are without having to travel so far. We have kept the spirit since the first time when we came to this committee, and also since the first time when we applied for the government to give us incentives. We've kept our commitment. As IDAC, we are continuously innovating. As we are now, we are probably the only company that is able to produce an entry smartphone device of $51 as per what we committed. And as we are talking now, we are also in advanced stages of, through our research and development, we intend to produce another cloud phone, another 4G cloud phone that should be able to sell in the market at below $20. When we sit here, the message that we would say is that stability in tax policy for us is very key, because the tax incentives that we normally get from the government are the ones that enable us to keep investing and to keep innovating, so that then we can help in the technology gap reduction and the acceleration of the access of internet and mobile networks. For purposes of this meeting, we have two proposals for tax consideration, and we'll start with the first tax issue that we have picked, and I'll hand over to Colazon to take us through the tax issue, and then thereafter I'll come in on the justifications of why we believe it is important for us.
Thank you, Mr. Kamunde. Honorable Chair and committee members, the reason we are before you here today is because on the 1st of July 2023, through the Finance Bill of 2023, we got VAT zero rating on the supply of locally assembled mobile phones. On 30th of October that same year, 3 months later, ICPAK was launched as a local assembler of phones. And the kinds of phones that the manufacturers have had are low-cost mobile phones that are helpful for our citizens who cannot afford high-value phones, and that actually covers 70.9% of Nairobi's population based on a March 2025 report. So now the finance bill is proposing to exempt the supply of locally manufactured phones, which is okay. And I say it is okay because the zero rating has actually led to ICPAK accumulating 1.8 billion shillings in VAT refunds, which is still sitting with the Revenue Authority. However, because it cannot be paid fast enough, then they are having to incur the cost of credit. But because we know that the funds still need to be affordable, and that was what government set out to do even in its medium-term plans, then we are here to say that we need to adjust the VAT treatment of the inputs. And so we are saying, please maintain the proposal to exempt the supply of locally assembled mobile phones. But in addition to that, we are requesting that you also exempt the VAT on inputs or raw materials that will be supplied to a local manufacturer of mobile phones. What does that do? If you look at the slide that's on page 7, when you have a scenario where the product is exempt but the inputs are not, then you end up with what you see in row number 2 there, where that VAT on column 2, which is 160, yeah? $1,000 is the cost of the phone, 160 is the VAT, the cost of the inputs, 160 is the cost, is the VAT cost on these inputs. And then if you have to apply a margin on all of your costs, the VAT is part of your cost because you cannot recover it. And so your customer ends up paying a bit more. So essentially, if we leave the proposal as is in the finance bill, there's going to be an impact to the price of the phone, and that is why we're requesting that the leg that has been left out, which is exemption of the inputs, also be included. Having touched on that, the second proposal is as a result of the realization, and I'll just go to the slide on page 15, please. So there's a realization that whilst the internet is an enabler for many things and we need to access the internet through phones, that is not enough. There are many other devices that are necessary to access the internet and all of the possibilities that it provides. And this could be laptops, it could be computers, it can be routers, it can be smart devices of various kinds, so that we are able to get the benefit that the internet provides. And so on this basis, we are requesting, Honorable Committee, that we also exempt the supply of locally assembled routers, locally assembled know your client and point of sale devices, locally assembled smart and Internet of Things devices. These can be things like smart meters, CCTV cameras that are locally assembled, then also customer premise equipment devices, modems and MiFis, as well as laptops, desktops, and tablets. But similar to the phones, we are saying don't just exempt the sale of the finished good, please also exempt the input. Because if we don't do that, then we will still be carrying an inherent VAT cost which the consumer must bear. I will invite my colleague to then speak to the justifications for these proposals.
And maybe through the chair, as I go to the justifications, I would want to just reference you to page, I think should be page 12, just to give a flavor of that second proposal, to just give a flavor of what it means to try and expand a little bit of the scope in which you are supporting the local industry to assemble. If you look at the graph on page 12, you'll notice that as it is now, devices that access the internet are around 94.2% on mobile phones. But the reality is that items like smart home devices, items like tablets, which is a key, I'm sure most of us here use tablets, is at a very low level. And the main reason why it is at this low level is basically around cost. So the moment we include them in that scope of what can be incentivized for local production, then there's the whole incentive for investments around that space and the ability to also bring in more usage and access to the internet through these other devices. And the other thing that I also wanted to mention around there is there are very many services that cannot be accessed, or the capabilities of a mobile phone is limited to certain functions. If, for example, as per the programs that we see now rolling out in the government, if we want to reach out to schools, the most effective way of reaching out to schools, for example, like we are doing now in health, is a tablet. So the moment you include that in this scheme, then you help us to provide to the market or to the economy on affordable devices of that nature, other than just mobile phones. So that was important for me to mention. So going back to the justifications, and I will also go very fast through the justifications. So first, we are saying that on page 9, on the presentation, page 9, we have indicated some of the key justifications why we are requesting this honorable committee through the chair to consider our proposal. Number one, we, like my colleague here, or my colleague presenter here said, we started just the other day in November 2023. So far, we have assembled 1.4 million. We have been very consistent in our tax payment at both importation and final payments. We have so far 1.8 billion of claims that we have made for refund. As a young company with a working capital that is constrained and having a receivable from KRA of 1.8 billion, you will agree with us that that is quite substantial. In fact, I want to tell this committee, these are some of the reasons why you find that a company has started very well in the first 1-2 years. It carries a little bit of the burden, but in the third year, it is no longer anywhere. It just collapses. We are at a point where we actually, whenever we go to the offices that we pass by, we tell them, please help us, because we feel the weight is becoming a little bit heavy, and we can easily close down, despite the promise of this industry. So that is one of the justifications that we are putting across, and it is affecting everybody who is within that bracket. Then we are saying that we expect that it will lead to higher consumer prices if we go through the current proposal of just exempting the output and leaving the input. That 16% together with any other costs that will be incurred along the chain, it will lead to what we have been trying to avoid by incentivizing the industry to produce affordable devices. And this also will also affect a whole chain of employed people. So far, like I said, in the course of our interactions, we have employed up to 700 people based on the demand that we get. So if these incentives are not sustained, then those people and the ecosystem that sells our devices across, who are thousands of agents out there, will all be affected, leading to significant impact out of this. Then we are also requesting the committee through the chair to notice that when the promises are made to investors to do certain investments, and they review and they find that they are favorable, and then they invest, if these promises are withdrawn before the investors are able to recoup particularly what they have invested, it creates some perception that is not very conducive for future investments within the economy. And we are also saying that by causing these devices to, which have started going, prices have started going down to go up again, then it also dampens the speed in which the acquisition of digital economy has been happening, and it also affects our blueprint as a government of Vision 30 and of 2030, and I think that would not have been the intention of the drafters of the current proposals. And so we are also lastly saying that, particularly from a mobile phone perspective, we know, because we have now been in the industry, we know that we still have a big portion of devices that are being sold in the market, and their tax models may be different from those of us who actually come and bring and we declare them on a phone, and we pay tax against each phone. So we are saying that if the tax treatments are so unequal, then it prohibits, or it makes it very difficult for the manufacturer, for the local assemblers and manufacturers to operate. And so we are calling the committee through the chair to consider that and help us to sustain what we have already started. I will quickly also go to what we had put down as the justifications for the VAT exemption on the additional items that my colleague has put across, which is in page 16. Largely, the bigger concept is the same, but what we were saying is that when you increase the scope in which the local assemblies are operating in, first of all, like we're talking from experience, if I have a bigger scope of things that I am assembling, then it gives me more incentives to have more people employed, and I am able to sustain them even longer. Because if I am only with one line, if that line is affected in the market, there are certain times you find that the factory is almost starting into a gridlock. But when you have a wide scope of, a wide SKU reach, then it becomes easier for you to plan in advance and plan ahead. Of course, including these devices will help it will impact the digital device penetration rate in Kenya because, like we have said, it will now reach. So if the government raised the 100,000 kilometers and leaves it somewhere next to your door, then you are able then to access a tool or a connectivity tool like a router or a CPE, what we call customer premise equipment, at an affordable cost, and therefore you are able to attach yourself to the what we call the dark fiber, and then enjoy the internet services. It will also make the devices affordable and mitigate the gray market imports. The more we go to the market, and we have found this, we have found the gray market complaining that our devices are fairly cheap, and they are taking some of them out of the market. So the more we have these devices out there, the better for both the government and the companies operating, because then we are able to chase out the gray markets. And as we have presented earlier on, you'll notice that IDAC has actually paid over 1 billion Kenya shilling on taxes to the government since we started, which I doubt most of these alternative markets have actually done, because it is not very easy to track them from a closer documentation perspective. And we also are saying that this expansion of the devices we are using is also in line with the digitization that the agenda that the government has, and the more, the better. We will also positively contribute to the creation of employment, the local transfer of technical skills, and increased revenue from employment for both the employees and the company. Just to mention that this year alone, I have paid over 350,000 on corporation tax alone. And that's a big for a company that just started the other day. So really, it is a mutual benefit for both the government and the local manufacturers. Chair, I think that ends our presentation. We will wait for your comments and for your questions as guided by you, Chair.
Thank you very much, CFO. CPA, do you want to go first?
Thank you so much, Chair. First of all, as I seek to appreciate East Africa Device Assembly Kenya Limited for showing up and putting up the spirited fight. I've tried to follow your presentation and tried to link to the bill before us, and I'm struggling to appreciate exactly which provisions, which clauses are you focusing at, other than the report that you're giving from the sector. That is one. Number two, you're saying that the refund claims, dues that you are yet to receive, is increasing the cost of production. I'm also at loss to understand how does an asset, quote unquote, a current asset that receivable for that purpose affects the cost of your production. You're asking that exemption should be provided for every other appliance for internet connection, modems, up to another one called MiFi. Is it M-I? We are used to Wi-Fi. Now, the other very jittery question I would want to ask is, what are the brands that are made by East African Device that if I can go to the shelf today, I could be able to see, buy, And what is the penetration in terms of percentage of the Kenyan market for that purpose that you are supplying, that you feel this particular adjustment in taxes, which you are yet to bring to my attention, you feel it is facing a threat. It will give advantage to the importers than the locally manufactured. And how many are you in the country that you're doing the locally assembled phones? I think, Chair, let me reduce my questions to that so that we are able to move together. And you're saying already the government of Kenya owes you 1.8 billion. So what is the total volume of your turnover? Like 2 years, for example. Thank you.
Asante Mheshimiwa Ruto. So my concern is we had this discussion around the same time. I think it was 2 years ago when we granted these exemptions. And the promise you made is that you would make devices available at a cost of less than 5,000 shillings. What is the current lowest price smartphone that you are now assembling on manufacturing in Kenya?
For the provisions of the Act.
Proceed.
All right. Honorable members, on the proposal to exempt the inputs for manufacture of locally assembled phones, we are making reference to the finance bill proposal at paragraph 36.0, or rather, read together with paragraph 37C, whose effect is to move the supply of locally assembled phones from the zero-rated schedule to the VAT exempt schedule. That is for the first proposal. On the second proposal, where we request that additional items be exempted together with their inputs, this is not currently sitting on the finance bill.
Thank you, Horazon. On the Chair, on your second question around our receivable, how the receivables would increase cost. Yeah, it's a cascade. So what would happen is that I will pay all my taxes, whether I'll claim them or not, in advance. So at the point of entry, I'll pay all the taxes that are required, whether it is VAT, excise duty, everything. Then I will assemble my produce. Then I will sell out to the market. Now, once I have done that, I will claim to the government. At that point in time, when I've claimed to the government, I will have to continue waiting now for the government to refund that receivable. Remember, at that point already, I have paid to the government the same amount for purposes of clearing the goods. So as I wait, if I am not very deep-pocketed, then I have to go to board,
Yeah,
and that is what
assist me, Chair, to understand from the presenter. I'm sure you have a cost accountant. Can that tax form part of the cost?
So what we are saying...
Or I agree, during the purchase, you are spending.
Yeah.
And in that expenditure is the cost of the item, which forms your purchases, plus the taxes, presumed the tax you are paying as an input, which the current law allows you, under zero-rated, to come and launch your claim now for the government to refund you.
Correct.
But from your presentation, and it's on record, that it increases the cost of production. That means the cost of your item is in the market right now, as factored in that taxes to form part of, because already you are saying that. So whatever margin you are putting, it means already you have absorbed the cost. So you should not even be lamenting as to why it's going to exemption, because you're already exempting it from your presentation, unless I'm not getting you. And it looks like then your prices is already depriving the consumer's rights, because you're going back to claim and already you have cost it. Thank you.
So through the Chair, just to clarify, the presentation is what will happen with the current proposal, but the 1.8 billion that we are claiming does not have that. So the 1.8 is vanilla. It is when we have not built in any cost in our costing. We are saying that in the current 1.8 is the norm of VAT that You come, you don't cost it in your product because you are saying the government allows me to go back and claim. So that one you put it directly to your receivables and wait for the refund. The second, the proposal that now is in front of you is where we are saying, at least we know that in the first one we were waiting for refund, so we could wait. The only thing that we have there is opportunity cost, so you can go to the bank and borrow and try to finance yourself to the best you can. But in this other case, we are saying, because we know that if it goes the way it is, then we will not be able to claim that, then automatically that will now flow through to the cost of the product. That's the different, sir.
All right, proceed with the answer of the questions.
Thank you.
Sorry, Chair. Just to you had a second question about the to confirm our turnover. So, so far we have now made in the short period between October to March, where our year ends, we had made 2.1 billion in sales, and this year we have made 6.4 billion. So, in essence, we have done 8 billion plus in turnover.
Through the chair, thank you very much for the opportunity. I'll speak about the questions touching on the brand, penetration, and threats faced. I'll also talk about the current pricing of these products in the market. So these phones, and I've carried a sample with me here, this is the Neon Ultra phone. The phones sold in the market are largely sold under the Neon brand, which is proprietary, owned by Safaricom, and ICPAK does manufacture on behalf of Safaricom. The current penetration, since it's the brand's launch in this market, we have actually been able to, as per the statistics received from Google, it's the third largest supplier of phones after Transsion Group, which do the Technos, and then Samsung. So it's number 3. In less than 1 year, it became the number 3 player in this market, which speaks of two things. One is how a conducive fiscal environment can actually create local champions. We are competing against the Samsungs, the Oppos, and the rest, and this brand has been able to do fairly well. The second question is what is the price and whether the benefits that this committee has accorded ICPAK or other local assemblers have been passed on. I can confirm and attest to the fact that before, because I sat before this honorable committee, the Smarter was actually retailing for around 11,000 shillings. When we got the exemptions, we were actually able to move it to around 7,500 shillings. And today, due to improved efficiencies and other benefits, it's currently retailing for 5,499 shillings, which speaks to the kind of that we are actually passing on the benefit to the consumer. This phone that I'm carrying with me here looks pretty much like the iPhones. It's actually retailing in the market for 9,000 shillings. The closest competitor you'll find will be going for around 15,000 shillings. And it is as good as any other international brand that you'd have. I carry it with pride knowing that this committee facilitated us to get the right relevant exemptions that were able to then produce such a world-class product that is globally competitive. In terms of the number of phones, in terms of the number, the other benefit about this particular, it's off, unfortunately. Yeah. But one of the other key things I'd want to emphasize on is the continued R&D. The phone that is circulating here, we were able to actually conceptualize it here in Nairobi, design a phone, and be able to circulate it in the marketplace. We are very much focused on ensuring that we even enhance this type of R&D and ensure that we're able to produce quality devices. Our philosophy is that a Kenyan should be able to have a quality device at an affordable price, right? Not compromising on quality. So we have been able to produce at the moment 1.4 million. That was the other question. What is the number of these devices in the market? 1.4 million is what we have locally produced. And our aspiration is that this year alone, we should produce over 2 million of these devices in the coming 12 months. I'd like to conclude my submission, unless there are any other emergent questions.
Yeah, Chair, the other question was how many we are
a minute, Chair.
Yes.
I wish before they wind up, if you could provide specs of this particular phone.
Okay.
so that we're able to align the 9,000 shillings in the market and its specs. It's unfortunate it's not on, so we could not see the visible features of the phone other than feeling the texture.
No, thank you. Through the chair,
And the chair, we also want to know if themselves they use it. Because there is a petrol station owner in my county who sells petrol to us, but himself he doesn't use it. He does not fuel his vehicles in his petrol station, so we start doubting if that petrol station is authentic.
I am confirming I have mine.
So through the chair.
And Chair, if they have some which we can buy here, thank you.
All right. Thank you, honourable members, for the questions. It's heartwarming to see the positive reaction coming. So the specifications of that phone, the Ultra 2, it's a 4+4. That is the ROM and a memory of 64. So it's 4+4, 64. So effectively, it's an 8 GB ROM and 64 GB RAM. In terms of the width, it's a 6.75-inch phone, which makes it actually bigger than your typical iPhone Pro Max. It's bigger than your typical iPhone Pro Max. Battery life, it's a 5,000 amp. The battery is 5,000 amps, which implies that it can actually go for up to 2 days. Up to 2 days without charge. So, and we thought of this because we were contextualizing it, that if this phone is going into the village, there's probably, your charging opportunities once every 2 to 3 days. So this phone is actually designed taking into account the local conditions and lifestyles that we have. Where can you buy it? These phones are available across the country in any Safaricom shop, dealers countrywide. Online, you can buy it from masoko.com. And it will be gladly delivered in this very location. So right now at masoko.com, you'll find it, or on any Safaricom dealer or shop countrywide. Our mission or our vision is to actually expand this. So when my colleagues presented around why do we want to expand these benefits, one of our key focus areas is schools, because we realize that studies have shown that it costs about 13,000 shillings per parent per year on textbooks. If we can replace that with an affordable tablet, if you've seen the kind of quality we are giving, an affordable tablet, which you can even now give in installment plans, it means that then you're able to enhance education and alleviate the burden our citizenry face when it comes to purchase of textbooks. So the proposals here are really to help us. The second proposal on expanding the range, which was a question that was asked, our commitment is that these benefits will be passed directly to the consumer, in this case to our brothers and sisters across the country. Thank you very much, Chair.
Thank you very much. So I'd raise a question on the 5,000 shillings.
Yeah.
We had a discussion with some stakeholders. There were some consultants who are presenting this on your behalf, I think yesterday, and asked them, when the exchange rate of Kenya shillings to the dollar was around 160, the phone was still 5,500. Even when we've done a huge saving in terms of our exchange rate going all the way to 130, the phone still remains 5,500. So is there really a commitment from your end to reduce the price of these smartphones? Because one of the things you're seeing a lot of this cleanup proposal, or this cleanup by National Treasury on our tax expenditures, is because studies have actually shown that when you extend these incentives to yourself, you don't necessarily transfer those incentives to the end consumer, and therefore your business expands, but really the intention of having the price of those particular products go down, doesn't go down with the same percentage.
Correct. I thank you, Chair, and the observations you've made are consistent across the industries. But I would like to highlight our commitment, because Safaricom is one of the shareholders of IDAC, our commitment to ensuring that these benefits are passed on. Before the assembly was put in place, these phones would cost for almost 11,000 shillings. As soon as the president launched IDAC, the prices reduced to 7,500. When the dollar, right now, if you are to go online, to any of our shops, that phone that was going for 7,500 is currently retailing for around 5,500 or 54,999 to be precise, or 5,400, which reflects the following. One is that the savings and the benefits that we're getting from Forex, the tax benefits are being passed on directly to the consumer. Our policy within Safaricom is that this is an enabler, right, to helping ensure that we connect Kenyans and transform lives. Yeah. So for us, you can rest assured that given our ethos, given our commitment, that any benefits that are received through either Forex exchange gains or, more importantly, through this committee, that they're actually reflecting on Kenyans' consumers and in the pocket. And that's one of the reasons why our penetration and growth has become quite high over a very short period of time.
So, if we grant these exemptions that you seek, how will that translate to the price of these funds now that they're 500? Do you see them going lower than that?
We see the following benefits that would come when you especially provide the input part of it. Number one is that we will be able to be in a position that will really address the cash flow issues that are facing the company right now, because it's getting to a point, as the CFO highlighted, it will be burdensome. But also that if we are to then have these exemptions in place, it would also help us ensure that we remain very competitive. Our commitment is that if you're able to offset the input and the output VAT, we'll ensure that our prices do not increase in any way. And if there are any benefits that are accrued right from that input, because today we claim back from the government, so we don't pass it. So the benefits is really going to ensure that we continue ensuring that these benefits you're passing to the consumer are sustainable. Because in the current state, where it is zero-rated, we would unfortunately have to pass it on to the consumer, which is not our desire. So our desire is that if we get both legs in and out exempt, our commitment is that the prices will remain the same, if not reduce, where benefits are accrued. And that's a commitment we have lived through in the past.
Did you train the codes, the HS codes, for those items that you wanted to be exempt, both input and output? That would help. It would be easier if you did that. So if you resubmit your proposal giving us those HS codes of those particular input, because we want, instead of claiming input VAT, you want to exempt both input and then output, so that there is the net effect. So the only way we will, if we would consider that, is if we had what the HS codes of those particular items are.
Consider it done. We will certainly resubmit the same. In our detailed submission, that will be resubmitted. And for us, this will ensure that this benefit the Kenyans continue to enjoy becomes a sustainable benefit. And you can hold us to account to ensure we pass on that benefit.
And Chair, for uniformity, maybe you may advise they stick to the format we've given, so that we're able to track what they're saying, what the law is, so that we don't miss out. You've given out a clear explanation, but then in your document, it is in your own format, so maybe you can improve it.
Well guided. Through the Chair, we'll resubmit the document in the format prescribed.
Thank you very much, East Africa Device Assemblers of Kenya. I think you're one example of how the amendments this committee has made has revolutionized particular sectors, and it's amazing. You know, sometimes I say we don't believe in ourselves as much as we should. Like imagining we have such a good, reliable smartphone being manufactured here in Kenya, you know, it's an amazing, amazing thing. And these tax incentives are the fact that they are able to drive such growth, as in something like looks as simple as change of a tax policy or change of a particular taxation, and that leads to an industry that is employing 750 people, selling 1.4 million devices, growing to a turnover of, you said you're targeting 3 billion this year. You know, that is really, really, really phenomenal. Thank you and all the best.
Thank you very much, Chair, and we really appreciate this committee's support.
Thank you very much. You're welcome. So Kenya, next to call is Kenya Property Developers Association.
Thank you.
Followed by IATA in Manda. Today we'll finish early, honorable members.
Okay, thank you, Chair, honorable members. Good afternoon. My name is Rose Kananu. I am the General Manager at Kenya Property Developers Association, and we're here representing the real estate sector, the members of our association. I will invite my colleagues to introduce themselves, and then I will talk a little bit about KPDA before they present our submissions.
Thank you, GM. Honorable members, good afternoon. My name is Wangoi Karuga, a tax partner at MAK and Partners Advocates. Today I come before you wearing the hat of the National Government Committee member within KPDA.
Good afternoon, Honorable Chair and members. My name is Marjorie Kivuva. I'm a real estate lawyer and partner at Tara Agility Africa. I sit in the National Government and Public Policy Committee at KPDA.
Thank you. Good afternoon, Chair and honorable members. My name is Benjamin Sule. I am a developer with Acorn Holdings Limited, and I am also part of the National Government Working Group at KPDA. Thank you very much.
Thank you, Chair. With your permission, allow me to briefly give a background about our association and the impact that the proposed changes in the current bill will have, which we want to acknowledge the work the committee did in terms of coming up with the tax incentives, particularly for the affordable housing program. And the current move to take back those incentives will jeopardize not only our members who have been working towards increasing the number of units that are being built under the affordable housing, but it will also impact the infrastructure that the government plans. So KPDA is an association of the private developers, mostly in the real estate asset class. We have 140 members, and we have been working very closely with the State Department of Housing, particularly to embrace these tax incentives that were introduced to essentially boost the affordable housing program, which is a key tenet in the government better manifesto, but also for the development of our country. Over the last 3 years, we've worked very closely with the State Department of Housing and even attracted a funding from FSD. And we currently have 12 of our members who are private developers that have applied for this tax incentive. And of those 12 members, we are looking at 6,900 housing units in the affordable housing. And we have another group that is currently in the process of application, which will bring the housing units to about 13,000. So the current proposals to remove the tax incentive is going to basically wash away all that hard work that has been done over the period. But if we look at the bigger picture, we're looking at a 200,000 housing deficit, the affordable housing deficit. KPDA is committed to working closely with government to increase this and accelerate the development of this housing. So I will now invite our members and our experts to table our submissions. Thank you, Chair.
Thank you, Rose. With your permission, Chair, I will address the clauses that we propose. I sat before this committee last year, speaking on the Finance Bill 2024. Some of the tax incentives that we spoke about are now again in the Finance Bill 2025. And we hope that even this year, you will consider us positively so that we can grow the real estate sector. So the Finance Bill proposes to delete the 15% corporate tax preferential rate and the third schedule income tax. This is in clause 28B2. The proposal seeks to delete that rebate where a company constructs at least 100 residential units annually, subject to the Cabinet Secretary of Housing approval. The reason why we are requesting that this deletion be removed and the current provision in the Income Tax Act is retained is because Kenya is an emerging market. Kenya has a growing population, approximately at 57.5 million, and the housing deficit is estimated at 200,000 units annually. Over 60% of Nairobi residents live in informal settlements where access to clean water, sanitation, and decent shelter is limited. The real estate sector is also a contributor to our value chain, where it creates jobs, urban planning, infrastructure development, and enhances the social welfare through housing, education, and healthcare. Tax incentives over the years have been provided by the government and exemptions to support government projects. The 15% corporate income tax rebate was introduced under the Finance Act 2016, specifically targeted at companies constructing at least 400 residential units annually. The government, at that time, in successive years, noticed that there were not too many applications, in our view, and amended the Act, Finance Act in 2023, and reduced the number of units to be built annually to 100 residential units. The history I have spoken about is because we have a housing deficit, and at that time, the government agenda, the Big Four agenda, housing was one of the key pillars. The purpose of the tax rebate is to help real estate developers make large-scale residential housing and to make the environment attractive to both local and foreign investors. And the government, through these tax exemptions and incentives, then invites the private sector as partners to bridge the housing gap. This current government, through its bottom-up transformation agenda, aims to supply 250,000 units annually and raise the percentage of affordable housing units from 2% to 50%. Just to reiterate the arguments on retaining the 15 corporate tax rebate for real estate players, we've seen this is something that has been adopted in other African countries, particularly in South Africa, where tax allowances have been provided in inner city redevelopment and social housing incentives that have been provided to private sector. We've also seen this in India, where interest deductions on housing loans, tax holidays for affordable housing projects are provided. As I've stated before, there's a case for the economic contribution by the real estate industry into Kenya's GDP. Looking at the most recent economic survey, it contributes over 7% to the GDP. It supports a vast value chain, steel, cement, timber, hardware manufacturing industries. It supports transport and logistics, skilled and unskilled employment from masons to engineers, professional services, a lawyer like myself, as a real estate lawyer. So tax incentives stimulate demand across this value chain, and removing this tax rebate could discourage investment in the industry, increase property prices, and slow down the housing development. So our proposal and our kind request is that the National Assembly considers to retain these incentives or introduce a scale tax relief based on the project sizes. By removing this tax incentive, the government undermines its own policy goal. Developers will have less capital to scale up the housing production, while new entrants will be discouraged by reduced investments on return. So this tax rebate ensures there's a delicate balance of supplying the market with housing units and giving an incentive to the players in the market to produce more units. It is clear that we all need a home, we need a house. All of us have a roof over our heads, we thank God. And the housing deficit is something that is a socio-economic goal, that we are saying that this tax incentive is a non-cash contribution by the government to meet this constitutional matter. It's not merely a fiscal matter, it is a constitutional tool to operationalize the right to adequate housing under Article 41. On my last point, what we have seen as KPDA and as a lawyer myself in this practice trying to help clients access these tax benefits, we see that it's premature to remove the tax rebate at this point when we've just had 2 years to access it. Most developers now are able at least to build 100 units annually. So how the development cycle works for real estate players, they estimate at about 3 to 5 years before they can get their return on investment. So tax planning is something that we help the private sector with as tax lawyers and as real estate lawyers at the inception of the project development. So an uncertain environment surrounding this tax incentive disincentivizes the developers from participating in partnering with the government to close this gap. We believe that the tax rebate is critical. It enhances public-private partnerships necessary to deliver large-scale housing, and the proposal to remove the tax rebate will adversely affect potential investments by both local and international players.
Just hold on a sec. Yata, please get in touch with our clerks there, the format in which you uploaded the document, so that they help with so that it's a way that it is visible for us from our sides. Okay? I proceed.
So to summarize, the real estate development is capital intensive. And as I've said, they project these projects 5 to 7 years. So when you start a project and you calculate your computation of tax at the commencement of the project, and in between the tax incentive is clawed back, this kind of destabilizes the investment by the real estate players. So far, I am aware that with the data we have from Ministry of Housing, 9 developers have accessed this corporate tax rebate, and the total number of units that they've placed into the market is 4,000. I'll go to the next clause, clause 36H of the Finance Bill 2025, which seeks to delete the current provision in the value-added tax, which provides a tax incentive, a VAT tax incentive or exemption for goods imported or purchased locally for the direct and exclusive use in the construction of houses and an affordable housing scheme by the Cabinet Secretary, that's for in relation to National Treasury, under the recommendation of the Cabinet Secretary responsible for housing. We propose that this deletion be struck out and we retain the current provision as it is for the same reasons that I have given on number 1, there's a housing deficit in this country, and number 2, the private sector is willing to assist the government breach the housing gap, and through this VAT incentive, they are able to reduce their cost of construction, they are able to put in more houses into the market and allocate their savings to the next project. The impact of retaining the VAT will support affordable housing, which is a crucial agenda for this current government, and it will align with government initiatives as now we have the 1.5% levy on gross income under the Affordable Housing Act. So they will be able to have more housing units into the market. The retaining of the VAT will also encourage private sector participation and incentivize the private developers in affordable housing projects. The economic and social impact of housing is very clear to everyone. It will lead to better housing for the citizens, contribute to job creation and economic growth. Removing the VAT exemption could slow down these developments and negatively impact the broader economy. I'm aware that about 26 developers have applied for the VAT exemption. It's a very rigorous process, and one of our recommendations actually would be to decentralize and remove National Treasury from the process and mirror the corporate tax rebate process, where it requires only the Ministry of Housing approval and they work together with KRA. So the VAT one has been more difficult to access. Private developers have taken about 12 to 16 months to get the VAT exemption. By the time they get the exemption, they are not able to recoup the objective of the exemption in their books. With that, I will ask my colleague to present the next proposals.
Thank you, Marjorie. Through the chair, we have two additional proposals that we wanted to make. Number one is on clause 27 of the finance bill that seeks to amend paragraph 1A and 1B of the second schedule of the Income Tax Act. So paragraph 1A and 1B seeks to extend investment in deduction, or what you call investment allowances, to high infrastructure projects of about 1 billion outside Nairobi and Mombasa, or 250 million, again outside Nairobi and Mombasa, and within special economic zones. Part of our national tax policy and MTRS medium-term revenue strategy is to rationalize some of these tax exemptions and incentives. While we are moving from extending some of these incentives, then we request that the committee considers deletion of that proposal to the extent that this particular incentive is targeting areas outside Nairobi and Mombasa. And we are aware of the high urbanization crisis with wanting to decongest cities. So entities that invest upwards of 1 billion or 250 million outside Nairobi and Mombasa then tend to qualify for 100% capital allowances on their investments. And what that does is that it boosts the social economic impact of the areas around that kind of capital investment. So this is in relation to creating employment, infrastructure development, schools, healthcare facilities, and that tend to develop and come up around them. I'll give you an example of a developer like Tatu City, which is located in Kiambu. So Tatu City so far has invested more than $1.2 billion within Tatu City, and that has created 25,000 jobs. And there are 88 businesses living off Tatu City development. So retaining these investment allowances for investments of this high capital nature outside Nairobi and Mombasa then tends to spur and incentivize developers to go and develop within those areas. Another good example is like the Vipingo Free Trade Zone. And this exemption covers people who have built buildings for manufacturing, equipment for manufacture, and also hotels. So something like Vipingo Free Trade Zone also it's located in Kilifi County. It's going to transform the landscape, the economic and social impact of Kilifi. Another good example is like what we have within Naivasha, the Freeport area. So with the government SEZ in Naivasha private developers are wanting to come up and set up all these buildings that will be used for manufacture and all that, and with the understanding that they'll qualify for 150 or 100% investment deduction depending on your investment threshold. So then the deletion of that proposal with a particular interest, say in the special economic zones, is that the second schedule and the bill have not provided an alternate rate for capital investments within special economic zones, which are very high real estate sector developments. So then, in the absence of a proposed rate for special economic zones, then does it mean that capital investments within special economic zones will not qualify for investment deduction because they have not been listed in any other paragraph within the second schedule except that paragraph 1A and 1B, which the bill is seeking to delete. So we urge the committee to consider to retain that incentive, especially for the special incentives around sectors outside Nairobi and Mombasa. Another proposal is around the carried forward of losses. So the bill proposes within clause, let me just get to that page, within clause 8C of the bill to amend section 15 of the Income Tax Act by limiting the carried forward of losses to an indefinite position and to restrict that to 5 years. So how this will affect the real estate sector is that, as we've seen, most of these developers are doing very high capital intensive projects. And if you are going to invest at least even 1 billion, what the Act envisaged within paragraph 1A and 1B of the second schedule that qualified you for an investment deduction, is that you're going to qualify for 100% or 150% capital deduction. Realistically speaking, if you've put an investment of 1 billion or even 250 million on the lower band, you will not be able to recover to a profitable level within 5 years. So the bill capping the loss carried forward provisions to only 5 years then sort of punishes our huge capital investors who are putting up these investments with the trickle-down effect of creation of employment and all the other additional taxes that will come from that kind of development. So then limiting the capital losses, limiting the carried forward of tax losses to 5 years, then restricts them from enjoying the benefits of their capital investment through actualizing these capital deductions, which would translate to the capital loss. We also note that the bill does not have a provision around the existing tax losses carried forward. So for a business that has 7 years probably to recover their tax losses, if then, say 1st July, the bill is in force and it's an act and this provision comes into effect from 1st July, what happens to my 7 years if then my year one becomes 2025? Does it mean in 5 years, the 2 additional years which I was carrying tax losses are going to expire? We have not seen a proposal towards that. And of importance to note is just a regional comparison. Within EAC, East Africa and Tanzania, our neighbors apply an indefinite carried forward provision. So then for businesses wanting to do such huge real estate, like mixed-use developments, where they know they will be able to carry forward their losses indefinitely, this might actually attract capital flight to the region, with having some of these real estate developers wanting to go and develop in Uganda and Tanzania to be secured with their tax loss provision. I guess lastly for us, what we had is a proposal on the VAT to do with within paragraph 36J of the finance bill that touches on paragraph 113 of the first schedule around the VAT exemption on specialized equipment for the development and generation of solar and wind energy. So as real estate players, most of the real estate buildings coming up now are going green, and they're going green by applying renewable energy, like having solar panels on top of their building. And for our members within the association who do very high capital-intense projects, most of them also seek finance from non-residents who require certain sustainability and certifications from organizations like EDGE that employ solar and renewable energy. So then with moving these items from exempt to the standard rate position, then it increases the cost of renewable energy and the cost of having to do, things around solar panels and this type of batteries which store solar power within some of these developments. And while, of course, the cost will be passed to the consumer, the other detrimental effect is the fact of having to complement electricity from the national grid with renewable energy. So then we request the committee to consider, and that was highlighted in detail by FCPA Robert under the Green Light Planet umbrella. So we request the committee to consider retaining paragraph 113 to have this solar apparatus and wind energy specialized equipment as exempt from VAT. That's all from our end, honorable members.
Thank you very much, Kenya Private Developer Association. Are there concerns from honorable members?
Thank you so much, Chair. Listening to the passionate presentation on clause 28, which took almost 30 minutes by itself. And then it shows this particular clause is very interesting and probably is going to till the sector. I just wanted to know now from the layman point of view, KBDA and probably the property developers, since this particular provision in the Act, Cap 470, are provided for exemptions, what is the behavior in terms of market price of houses now? We are aware government is doing theirs under affordable housing, private developers are doing theirs. What is the tilt? How has this influenced the prices for housing in the market? So that we get to appreciate just from what is happening. Thank you so much.
Honorable Boni?
Yeah.
You have, Honorable Boni, are you officially a member of this association? I know you.
Chair, I want to develop for my own use, not for Sarah. Yeah, but I think the presentation is very good, and although I have a few questions too. One, I've just been wondering how within 12 months a developer can develop around 100 units. I don't know if really is this one who can do that, considering the stages of putting houses, because there are some stages you cannot really jump. But I was expecting to see you bring out the issue of clause 59A and B and C. On the export promotion levy of 70% on steel, what we call billets, because these clause came into being in the bill of 2023, finance bill of 2023-24, and from then we saw it was 17.5% on billets and clinker, and then we saw steady increase of those two products, steel and cement, because those are inputs to this, and how it affected the cost of construction. So I was really eager to see that, but I think you have really considered on the income tax and VAT, But I think next time you also need to look at that, because those are the issues which also are affecting the cost of construction and negating the affordable housing scheme. But otherwise, I'm happy. You have done very well. I think you are complimenting the government on affordable housing. Although yours are not very affordable, but at least because of the government is also producing many, yours have to come down because the market forces of demand and supply has to apply. Yeah, thank you.
But maybe, Chair, to disagree with Mboni, because he seemed to be protecting. Remember, the exemption is meant to benefit the common mwananchi. So despite the fact of supply and demand, which can determine the price as to the situation of the market, but this particular benefit, how does it get the exemptions that they're deriving under section 470, that is what is section 2, yeah, but the second schedule part P, and third schedule part P of Income Tax Act, which this particular amendment now in this bill is seeking to eliminate, but they have been enjoying it. How is it been benefiting Mwananchi?
Okay, respond to those concerns by honourable members.
For the first question, I will allow the private sector developer player to answer the questions related to the question of the prices and how does it trickle down to Mwananchi.
Thank you, Chair and committee members, honorable committee members. I think the first question was the impact of these exemptions. And for the properties that have been developed through, with the exemptions in place, and maybe just before I get there, I need to state that the process of getting the exemption is very complicated and long, so that by the time you get it, you've already spent on the capital-intensive materials, which is basically steel and cement. The process takes about a year and a half from registering as a strategic partner to the affordable housing to getting your very first exemption. The construction process, the formwork is about 2 years. So if you're spending a year and a half chasing the exemption, and you need to build in a year and a half, you see you'll have already spent a lot without the exemption. Be that as it may, you will realize that for privately developed affordable houses, the cost of that house is very close to what the government is selling on Boma Yangu. So you will see that a three-bedroom house on Boma Yangu will be around 4 million, which will be the same or near what is constructed by the private developer. But keep in mind, the government does not incur land acquisition costs, but the private developer has to. The government does not have to raise that revenue because we are paying it through the affordable housing levy. Yes. So despite that, the cost at the market level is still the same. So in terms of the impact of the exemption, there is a little impact in terms of, because when we get it, we can use it on things like paint and other final finishes. But also, in the process of getting the exemption, to ensure that we adhere to to affordable housing, to the tenets of affordable housing, we get into an agreement with the State Department for Housing, VAT adherence agreement, in which you agree with the State Department that if given this exemption, and when I utilize it, my unit will be sold at this rate for this time, all other factors constant. So we do have that agreement with the State Department, which when we get the exemption from Treasury, we have to maintain, because otherwise we'll have to basically show cause why we did not adhere to the agreement.
Right, the rest of the questions.
Okay. So to respond to some of your questions, Honourable Member, on the issue around export investment promotion levy, we note that that has come down from 17.5 to 10% in the bill, and we actually load the reduction. But what we did in our submission is we focused at the key issues that will affect developers, and we sort of left this one for the manufacturers who are manufacturing it locally, because they're the ones who, if you know.
But it is still affecting you.
Yes,
it does affect.
Yes,
it does.
It does.
Yeah. So you cannot say you are left it to manufacturer. Anything which is affecting you, I should be part and you should be concerned.
But you see, Chair, that proposal is a relief in itself. From 17 to 5.
It's come down.
It's a relief.
So it's come down. That's why we did not sort of highlight it.
So
maybe through the chair.
And if you continue like that, you sit on the other side.
you know, Chair, why I'm saying this, because you see, this one affects the small people like me and the chairman and others who are trying to get their foot in real estate. But you see, for the big players, they are concerned with other big things like corporate tax. Me, I will not even claim corporate tax. But if I see the cement going down, the steel going down, I'm comfortable.
Through the chair, if I could add, construction and manufacturing go together. So it's not like we left it to manufacturing because it doesn't affect us. We are in collaboration with them. But maybe to add on to a question that was asked, how is this incentive being passed down to the consumer? We look at a situation where these incentives are actually creating a favorable environment to increase not just not only the stock of real estate that is being produced, but it's going to create huge employment, because manufacturing and construction, real estate are the two sectors that create high employment. And of course, that has a direct socioeconomic impact. But also, when we created an environment that is favorable for investors, we're going to start attracting construction technology-driven companies, which will bring our construction durations, they'll shorten them. We even have local manufacturers such as Space and Style that have construction technology that can speed up the construction. We will be able to attract other international players that can help us, Honorable, to build those 100,000 units within a short period, because we are not using the traditional brick and mortar kind of construction, but we'll be able to attract rapid construction technology into the market. So this incentive is in early stages, and I would urge that we work in collaboration and really just safeguard it. Let's extend it so that we can open up the space, build more houses, attract investors, and at the end of the day, it is the common mwananchi that will benefit in the long run with the affordable housing programs.
Through the chair, just to summarize, and first also clarify, honorable member that also asked about how do smaller players get to access these tax incentives. If you look at our proposals, we thought about that. We would not want these tax policies to be confined to big players. Even small players should be able to access. One of the proposals, and for corporate tax rebate, it's important to note that it does not apply to affordable housing. It applies to any residential player, anyone who's building a residential home. So the qualifying units that are awarded right now in the Act is 100 units. We are proposing that you can consider reducing this to 50 units so that other players can access this. Yes, honorable member. The other proposal that we've put there is that from my practice as a real estate lawyer, I see a lot of people who own land but don't have the capital to build these large-scale residential projects. So they enter into joint venture agreements through a legal vehicle, the limited liability partnerships, LLPs. from the wording of the income tax, only companies are the only legal entity that are recognized as the legal entity that can access this corporate tax rebate. So our proposal is that you consider to make it accessible to LLPs so that JVs can be materialized where there's a landowner who might want to partner with a company or a foreign investor who has the funds to build more than 100 units or 50 units if you consider to reduce this. And we'd be very glad to see that in the Finance Act 2025. For the VAT, the exemption, we've proposed that the National Treasury is removed from the process so that we can have more accessibility for everyone, including the small players. It's very difficult for a private developer, a small private developer, to keep going to National Treasury to be able to meet, and there's a lot of red tape involved in that. So we would be appreciative if you consider our humble proposals and we partner together to build the real estate sector. Thank you.
Maybe I was looking at the annual economic survey, and I think table 2.2 on the domestic economy. The sector, the consolidated sector, has gone down by negative 0.7%. Could you be having reasons why it has gone down? Considering all these incentives you have got, why is the sector not performing?
Thank you. Through the chair again. I think it's very important that we make it clear that the incentives seem to be more available. It's like on paper they exist properly, but in order to finally access them is very difficult. Like I said, it takes about a year and a half to get your first exemption, VAT exemption, time during which you've already done the capital-intensive work. So, I mean, if you're...
What is the challenge? So that because we are here also...
Yes, absolutely. I am glad you asked because I have it here. The challenge that we have is the application is done to the State Department for Housing. The State Department for Housing then writes to Treasury saying that this developer has written to me to request this exemption. Then Treasury writes to the Kenya Revenue Authority, and then Kenya Revenue Authority approves, writes back to Treasury, which then writes back to State Department for Housing to write to the developer saying you have finally passed this stage. So the bureaucracy in that process is long, which
it takes a whooping 18 months to finish that.
Imagine that, yes, it does.
Yes, one letter that can be delivered in the morning, can be acted upon by midday, by evening, it is at the receiver. And so by next week should have been completed. Okay.
Of course, the application happens in two stages. The first stage is for you to become what the housing department called a strategic partner to the affordable housing program. So your company, you register it. So the process, registration process takes about 6 to 8 months to become a strategic partner. It involves, submitting your documents, your tax records, your plans, and all those things. And then they give you a certificate. Thereafter, you submit your bill of quantities for the materials for which you're seeking exemption. These materials will then be analyzed by the quantity surveyors at State Department for Housing, and then they write to the Treasury Department to look at it and to allow that exemption. Then Treasury writes to KRA, and then now that process again takes another 6 to 8 months.
I think what you need to do is that you need to sit down and do analysis of the challenges, because what you are saying is one challenge. There are many challenges, even with the inputs, right? All those approvals from is it a city council or whatever? Those approved, they also take too long. So there are so many challenges to the sector. I'm a small player, so
you're conflicted.
I'm not conflicted. I think if you can sit down.
Even the land registry.
Yes.
Even the land registry.
Yes. For example, you may want to have a joint venture. Now, if you to get that transfer alone, yes, I'm saying that because I'm being affected. If you to get that one alone, it's a big problem. So there are so many challenges in the sector that really the government need to do something about it. If really we are going to move.
We would be happy if you help us. We sit in the National Government Committee at the Kenya Property Developers Association, and also the county government working group, and these are the things we are trying to address. So we will be helpful.
I got some concern. In the meantime, while you are seeking for this approval for 18 months, what are you doing as a developer? Are you on the side doing your own work as usual? And what is the end product? And how are you going to treat that end product after that 18 months when you eventually you receive the approval?
There are costs to, once you hand over the site to the contractor who's doing the work, you start accumulating what you call your prelims. There's already cost to that. So you cannot delay the construction process. In fact, delays may even cost more than the exemption that you're seeking. So as a developer, we are compelled to continue with the development as we seek this exemption. So sometimes we are lucky to...
I think I've got it, but finally, when you finish construction,
yes,
what informs the market price of that particular? Do you now sell at a market price disregarding this one, or do you influence it with the exemption?
I think the critical question here CP is trying to seek, what guarantee can you give this committee that if that exemption is granted to yourselves, it won't lead to more profitability for developers, but will go towards reduction in the final price of that particular product?
Thank you. We had actually written as one of the proposals that we have for that. I think the fear that probably Treasury has, and the reason why they're seeking to take this exemption, firstly is because there's been a claim that this exemption is probably used by unscrupulous developers for their own private gains, and that you were given this exemption but you don't use it for the intended purpose. And the proposal is this: because there are already too many players in that bureaucracy. If we can have either State Department for Housing, because I will tell you for free, there is minimal oversight on this. There is minimal oversight on the exemption so that you can apply for it, and no one in particular checks whether you're using it for the right place. In fact, it is your own volition as a developer to show this data to State Department so that you encourage them to give you more. So I would propose reduction of the bureaucracy and more oversight so that developers have to also give returns on this. Because if there is developers who are giving returns on this, then you are sure that they have to report on the exemption given and its utilization.
Chair, this is an association of real estate developers, right? Actually, your work is now to look at those challenges and see how you can sort them out. In fact, that's why you have been, the association has been formed, so that you can champion the interests of the real estate developers. So next time you are coming here, you come here with the challenges, all the challenges. We see how we can help you. Yeah?
Thank you very much.
Yes.
Thank you.
Thank you.
Thank you very much, Kenya Private Developers Association, for your presentation. You may take a leave at your own pleasure, or you can observe the proceedings. Our next stakeholder is Yata.
Good afternoon, Honorable Chair and Honorable Members. My name is Agnes Mushuha. I'm the Country Manager East Africa for the International Air Transport Association. And I'm also joined by my two colleagues who will introduce themselves.
Afternoon, Chair. My name is Paul Motegi. I'm Managing Partner at Tara Agility Africa and supporting IATA in this effort.
Honorable Chair and the committee, my name is CP. Okay.
Or can now move to that one and then CPA kuja hapa.
Thank you, Chair. Honorable Chair and honorable members, my name is CPA Beatrice, a partner at Tara Agility, supporting IATA.
Honorable Chair, good afternoon again. My name is Marjorie Kivuva. I'm a legal partner at Tara Agility, supporting IATA.
Honorable Chair, the International Air Transport Association is a trade body that represents the world's airlines. We currently represent over 300 airlines globally, and we are present in over 183 markets. And in terms of our contributions to the global aviation industry, we do represent over $338 billion in terms of global aviation trade, which signifies 83% of the world's air traffic. Our mandate is primarily to represent and serve the aviation industry and to safeguard on the industry standards so that we can ensure safer skies for the safe conveyance of passengers and goods. I turn it over to my colleague, Paul, who is going to take us through the technical submissions, and I will come back in to provide the justifications for the industry. I submit.
Thank you, Chair. So I'll just give, on a very high level, the architecture of the changes that have been proposed. These changes appear to mirror the proposals that we saw in the Tax Laws Amendment Bill 2024, where we appeared before you and made submissions, which you graciously agreed to. The bill proposes to delete under the first schedule, part A1, paragraph 49. The first schedule deals with exempt goods and services, and therefore by deleting all goods and parts thereof of chapter 88, what it does is that it makes taxable aircraft goods, parts, and appliances. And if you look at how the wording has been done, the wording under the two amendments that have been made under the VAT Act, meaning section 36A and section 36D of the finance bill, which now does the same thing to direction finding compasses, this wording has more or less been mirrored under the proposals in section 58A and 58B, but now relating to railway development levy and import declaration fees, which are applicable on importation of these goods. Generally,
but maybe just for your information, just for information's sake, when it is on the bill, it's referred to as a clause.
Clause, yes.
Section is the act, is when it becomes law. So you intend to mean clause, that is 6D of the finance bill, not section.
I stand guided. Yes, so so by that I meant clause 36A on the deletion of section 49 or paragraph 49 in the first schedule, section A, part 1, clause 36D, which relates to the deletion of, in the first schedule, part A, we're deleting paragraph 58, which relates to the direction finding compasses. And then the equivalent provisions in the Miscellaneous Fees and Levies Act is clause 58A and 58B. And you will see in the justifications that Madam Agnes will give that we will be dealing with them in that way. In addition to these 4 clauses, we are proposing 2 new clauses as part of the cleanup of the VAT Act, and simply to bring clarity, particularly in terms of the taxation of the aviation sector. And the 2 provisions that we would like the committee to consider is in paragraph 5 of Part A of the 2nd schedule. We would be requesting the committee to include the words cargo to that provision. And the reason for that is that cargo is a significant part of air travel within Kenya. And by expanding this scope, the VAT Act, particularly the 2nd schedule, will not only cover the conveyancing of passengers, it will also cover the conveyancing of cargo. And the second new clause that we would like to be considered for amendment is under the 2nd schedule, paragraph 6, Part A, where we would like the words taxable services to be substituted with the words taxable goods and services. And this is part of the broader cleanup to ensure consistency in terms of the approach of the taxation both of services and goods under the VAT Act. I submit and pass it over to my colleague Agnes.
Honorable Chair, in terms of the justifications that prevail on Clause 36A and 36B, it is to be noted that as per the IATA safety reports for 2024, the African continent was noted to be citing the highest aircraft accident rates, specifically those that are attributed to the turboprop type of aircraft. And hence, our submissions to the committee to consider the proposal that we retain the current provision of the VAT Act of 2023 by not approving the deletion, as this will ensure that the airlines which are operating in the Kenyan skies can access their spare parts at an affordable rate, and that, you know, the VAT exemption that is increased, and that the VAT exemption and increased domestic travel revenue is realized from the domestic and regional travel. And we also highlight from a safety standpoint as well that there will be an irrecoverable VAT cost to the domestic airlines. And it should be noted that the imposition of the VAT on such supplies will represent an additional and irrevocable cost to both domestic airlines in Kenya, as there is no input tax credit that is available on domestic transport services. On the section that is pertaining to the growth of the drones and aviation in the aviation industry, this is a new innovation that has come in, and it is supporting the last mile delivery. We have seen its high adoption and utilization in the pharmaceutical industry, and it is also being used in the agricultural industry in terms of conducting surveys and monitoring the weather patterns. So it is critical that we continue to enable and support the growth of the drone technology, as this has an opportunity to unlock the growth and expansion of the last mile delivery, focusing especially in those hardship locations in the northern part of Kenya that are difficult to access due to the lack of infrastructure, and at the same time allowing for the drone technology to support the agribusiness, which contributes to over 30% of Kenya's GDP. Under the clause 36D, we need to also take note that according to the IATA security report of 2024, it was noted that there has been a significant increase in the interference and the misleading of the aircraft navigation systems due to the interference on the global navigation satellite systems. This poses a direct risk to the civil aviation industry. We have noted that this disruption of the air navigation systems has increased at a rate of 175% as of 2024, and hence it is very critical for this committee to retain the current provision of the VAT Act of 2013 by not approving its deletion, as the airlines rely 100% on the direction-finding compasses and instruments for purposes of safeguarding on the aviation industry safety and security measures that ensure that both passengers and goods arrive at their destination safely. Under the Part A of paragraph 5, the reason as to why we are submitting to this committee the inclusion of the words cargo immediately after the words transportation of passengers is the recognition that, according to the Kenya Airports Authority audited accounts of 2023, the sector generated 377,000 tonnage of cargo uplift from Kenya. And we noted that as per the IATA economics report, the cargo industry in Kenya ranks 94 out of 189 global trade markets. And this presents a huge opportunity for us to support this sector, which directly generates foreign exchequer for the country, largely driven by the horticulture industry, the perishables, the meat products, and the pharmaceutical products that are being exported into other countries. So our submissions to this committee is to really look at the cargo sector as an opportunity for growth that will directly contribute to an increase in the FX for the country, which will also contribute to the balance of trade when it comes to the imports and exports. Under the clause 58B of the finance bill, we are looking at the request that we need to retain the current provision of the Miscellaneous Fees and Levies Act. Through the committee, we submit that as per the Kenya Civil Aviation Authority report of 2023, we noted that 6.2 billion Kenya shillings was generated from the air navigation service fees, and 3.2 billion Kenya shillings was generated from the air passenger service charge. Collectively, this amounts to 9.4 billion Kenya shillings out of the 10.1 billion Kenya shillings that the Civil Aviation Authority reported. This revenue was driven by 11 million passengers who comprise 5 million passengers who traveled in the domestic sectors and 5.7 million who traveled in the international sectors. Through the chair, our submissions are that we see a huge opportunity for the government to realize a higher revenue, largely driven by the air navigation service charge, and to unlock a higher revenue for the exchequer. It translates to the need for us to urgently increase the air capacity into Kenya. And what that will do is that it will expand the tax base for the country, and it will also expand the revenue base for the Civil Aviation Authority through the air navigation service fees that are collected for the airlines who are taking off or landing into the country. The second driver for the revenue, which is linked to the passenger service charge, it is linked to the departure tax of $50 for international passengers and 600 shillings for the domestic passengers. And so the opportunity that we are seeing, it's for the government to increase the passenger volumes. And to achieve this, we see a need for the government to actually increase the air frequency into the country. And the impact of that is that the tax base is going to be expanded, and it will make the country or the destination more attractive, and it will also support the other revenue target for the Ministry of Tourism for increasing the tourist arrivals into the country, which again will have the positive domino effect of increasing the FX inflows into the country. So with that, we submit that there is a need for us to really focus on ensuring that the higher costs on spare parts are discouraged, and that we safeguard any measure that will enhance the aviation safety and security. And we also take into consideration the fact that for your last mile, and this now largely focuses on the tourism sites, they rely on the small operators from Wilson Airport. These are your turboplane operators who travel to Masai Mara and all the other attraction sites in the country. And so we need to ensure that all their direct costs related to spare parts and any other related direct costs that are attributed to an increase in VAT is eliminated. We also would wish to highlight to this committee, reminding us that Kenya is a signatory to the ICAO, and within the ICAO policies on the taxation under document 8632, it seeks to prevent the imposition of taxes on the sale or use of international air transport, and it states that each contracting state shall reduce to the fullest practicable extent and make plans to eliminate all forms of taxation on the sale or use of international transport by air, including taxes on gross receipts of operators and taxes levied directly on passengers or shippers. We also would wish to submit another reminder that Kenya is a signatory to the Chicago Convention on the Civil Aviation, and within the Article 24 of the Chicago Convention, it does state that aircraft on flight to or from or across the territory of another contracting state shall be admitted temporarily free of duty, subject to the customs regulations of the state, fuel and lubricating oils, spare parts, regular equipment, and aircraft stores on board an aircraft of a contracting state on arrival in the territory of another contracting state and retained on board on leaving the territory of the state shall be exempt from customs duty, inspection fees, or similar national or local duties and charges. This exemption shall not apply to any quantities or articles unloaded except in accordance with the customs regulations of the state, which may require that they shall be kept under customs supervision, I unquote. So through the chair, we would want to impress again on the Chicago Convention and ICAO's policy on taxation that states for the provision of a reciprocal exemption for customs duties, excise taxes, inspection fees, and other similar duties and charges on aircraft, fuel, lubricating oils, consumable technical supplies, spare parts such as engines, aircraft equipments, and aircraft stores used in connection with the specified services. This exemption should apply to items and goods that are introduced into the counterparty territory or retained on the broad or retained on board the aircraft on arrival into or departure from the counterparty territory, or taken on board the aircraft in the counterparty territory. So the rule of reciprocity here needs to be respected so that, again, we ensure compliance with the ICAO guidelines and the Chicago Convention. And we have also seen a benchmark recently from the ECOWAS region. The ECOWAS, this is the ECOWAS region consultative meeting that was held by both ministers and experts on the 5th and the 8th of November 2024 in Lome, Togo, have endorsed the elimination of taxes and charges for the aviation industry in the ECOWAS skies. So by borrowing from our brothers in the northern part of Africa, we also stand to benefit from the good practices that they have embraced of supporting the elimination of taxes, charges, and fees that will curtail the growth of the aviation industry. Honorable Chair, in closing, I wish to emphasize and highlight that the aviation industry in Kenya has been growing, and in 2023, it realized $3.3 billion for the exchequer, which is representative of 3.1% of Kenya's GDP, creating over 460,000 jobs for the Kenyan citizens. So we submit that to this committee to consider favorably our submissions, as we have a strong belief that based on the data and statistics before us, by granting those exemptions, we stand to unlock the opportunities that the aviation industry represents, and more so to spiral a positive inflow of FX from other global markets who trade with the country. I submit.
Thank you very much. CP Ruto.
Thank you, Chairman, and I want to appreciate IATA for the lengthy and detailed submission, which is taking us far and large to the whole world. When you're talking of ECOWAS, I'm trying to imagine how Kenya and ECOWAS can directly benefit. But nonetheless, to say, I know in aviation, it's another world, and we are not exceptional. The only thing that you've given somewhere here on safety issues, I don't know whether it is factual, on the issue research or statistics which have been made, that Africa is a very risky environment to fly. But yet, other than the Ethiopian airline, which has taken almost, it's unfortunate, has taken almost more than 6 years or so. I think any other sad news is here too. But America, every 2 weeks, something is reported. 2 weeks, something has happened on the airspace. But then how does Africa be seen to be a very risky environment that requires even us now to forego our own gain, our own tax plan, to finance our own budget at the expense of the report that indicts Africa? Thank you, Chair.
Thank you. Can you respond to that first?
Honorable Chair, indeed, I have cited the IATA safety report of 2024, and this report is based on the incidences and accidents that are reported through ACI. And ACI receives all these reports from the civil aviation authorities globally. And based on all the reports that came through, the highest rate of accidents and incidents distributed across the continents came from Africa. And it is largely driven by the turboprop type of aircraft, which is commonly used within the African continent. And mainly this is attributed again to accidents that are linked to the parts of the turbo aircraft type. I submit.
You know, I was looking at this Convention on International Civil Aviation Convention, that Article 24 that prohibits Kenya from imposing these particular taxes on this kind of aircrafts, for example. And I'm really wondering, Article 2(6) of our Constitution talks about the supremacy of the Constitution and says, Article 2(6), any treaty or convention ratified by Kenya shall form part of the law of Kenya under this Constitution. But again, if you check Article 2(6), Article 2(6), 2(9). It is 2(6), 2(9). It talks about only the national government may impose income tax, VAT, custom, excess. So I'm wondering, the same Constitution grants National Assembly the absolute right to impose taxes. And again, 2(6) forms that such a convention forms part of Kenyan law. And so I'm wondering, which now should we implement? Should we implement 209? Or should we go to 2(6) that now says that we must do that? Anyway, just legal law is not my expertise, but just
Chair,
about.
If I could just chime in, these provisions, the international law does not limit the National Assembly's power, which is the reason why we are submitting here. Meaning the Kenyan National Assembly has full authority to vary local law in terms of public interest, which is your constitutional duty. The reason why international law is important in this scenario is, particularly in the airline sector, reciprocity is a very big part of how global airlines function, because they work in a very significant network, and by virtue of ICAO, then, and the Chicago Convention as well, then essentially what different jurisdictions are doing is trying to set a scene where the operation of these airlines is tax neutral. So the reason why, in fact, these provisions have always historically been in the VAT Act since 2013 is a recognition of this rule of reciprocity. To answer the question on safety, just to add on to what my colleague has mentioned, essentially there is very limited room to collect any significant revenue from direction finding compasses and appliances and equipment. So if you counterbalance that with the real risk of increasing a potential to, these turbo planes not being refurbished in a timely way because of this additional cost, then I think the scale balances in favor of safety rather than the very small tax that may be collected from that. I submit, Chair.
All right, thank you very much. There are no big additional questions. Your submissions are well received. Thank you for your time. So the last stakeholder for the day is MADA. Associates, you've Manda and company advocates. So please, it being the end of the day, try to and you've listened to most of the presentations that have been made. Try to take us through what has not been mentioned by the other stakeholders. Proceed.
Thank you, Chair. My name is Peter Manda. I'm an advocate of the High Court of Kenya and a resident of Kiambu County. I make my submissions generally as a citizen of the country and cognizant of the fact that it is critical for all citizens to participate in these proceedings. Chair, my proposals have been summarized in the memorandum I presented before you. And like you've said, yes, some of the issues I have raised in my proposals have been touched on. So I will therefore not repeat them for the sake of time. Perhaps I can just go straight into it and start with the first proposal where I had talked about the restrictions on the ability to carry forward taxes. I think ICPAK talked on that. I will leave it at that. The second proposal would be that on the issue of refund of VAT, paid or outstanding debts, essentially what I'm saying is that the current VAT refund policy on bad debts has a 3-year period. The Finance Bill 2025 has proposed a shortening of that period to 24 months. My proposal is to further shorten it to go within 12 months. That is essentially a year. And the purpose of this essentially is to reduce the time within which these administrative processes happen, making it more, promoting greater trust and fairness in the tax administration process. Also, I think it goes in line with the fact that once KRA has issued once this timeline has been established to be 12 months, then it's pretty clear for a business what is going to happen in a very short time, therefore decreasing uncertainty. Therefore, the proposal is to enhance the period to a shorter period from 2 years to 12 months. Also, I had mentioned on the issue of locally assembled devices. I believe there was a very enlightening presentation from EADAC, who have launched locally assembled phones. And perhaps the only contrast to their presentation and mine is the fact that I had proposed that we include a section to now cater for what they were calling inputs, the disassembled and unassembled kits, so that they are also VAT exempt, which is, I believe, what they were trying to say earlier. Fourthly, my other proposal was on integration, on the issue of integration of the taxpayers' e-teams with the Commission of Data's management and reporting system. Again, I think this has been mentioned previously by other parties who presented before yourselves. And the main challenge with this is the fact that it violates Article 31 on the right to privacy. And we can be sure that should this pass, then there will be a petition to challenge it in court. Point number 5 on the introduction on investment allowances on spectrum licenses. This had been previously proposed in the Finance Bill 2024, but was dropped. I think it's important that teleco companies are also given a reprieve on the investment that they make on spectrum licenses. And this essentially is meant to be a continuity to incentivize them on investment in Kenya. Because the only current exemptions we have on capital allowances only relates to fiber optic cables by the telecommunication operator. So essentially we're saying that, yes, you've bought the fiber, you've gotten to the sea, but then once for you to spread your communication on spectrums, you're still having to put in a heavy investment. So I think it would be a reprieve that would perhaps be translated to the consumers should they be allowed to gradually claim these allowances as they use the spectrum license. So my proposal is to amend the paragraph 1C of the second schedule of the Income Tax Act to allow telecommunications operators claim investment allowance on spectrum fees. With respect to issuance of demand notices, that is agency notices, under Section 4214E of the Tax Procedures Act, currently, I think this has also been talked about by ICPAK, and it goes towards violation of Article 47 and Article 48 of the Constitution as far as fair administrative action and access to justice is concerned. I think parties should be allowed to exhaust all appellate avenues before KRA gets to demand from them, and I think that has been spoken on severally. I will not reiterate it further. My seventh proposal touches on the reduction of excise duties on fees charged for money transfer services from 15 to 10%. The current rate is 15%, and this has been harmonized across all excise duty fee charges on money services. However, it's my proposal that this should go down to 10%, because you find that mobile money transfer services are used by the majority of Kenyans, and they are sort of an alternative to the formal banking sector. So giving Kenyans a reprieve on how much they pay for money transfer will go a long way in growing the economy and encouraging the transmission of money across. I mean, more people send money on M-Pesa and Airtel services rather than through RTGS. It's only fair that Kenyans get further reprieve on the excise duty that is charged, which would be a direct translation on the transaction fees. Number 8 of my proposals deals with changing the effective date of the compliance with E-Teams regulations. And essentially, I'm proposing this in light of the fact that there has been numerous challenges faced by users of E-Teams and the rollout in itself. I don't believe that they achieved the target that they had set out. They only onboarded 202,000 businesses with a set target of around 915,000. And the fact that the deadline has passed has created many administrative issues, which should this committee consider looking at, then it would grant Kenyans more time to comply. It would grant KRA more time to inform Kenyans on what they need to do so that they're able to comply with E-Teams and regulations for their businesses. And this would also avoid future tax disputes on this issue. Now, I have come up with 2 extra proposals that I would wish for the committee to consider. And Chair, this is with respect to KRA's funding. And my proposal is to remove the discretion of Treasury as to how much they receive. This is informed by the fact that KRA is, I believe, attempting to do as much as it can to set the targets, to meet the targets set. And when it comes to them being funded for them to be able to carry out their activities, there seems to be, it is discretionary. It is what Treasury decides to give them, but it has been capped to a minimum of 2%. So my proposal is to give them a range where Parliament is the one now to decide. You set your target last year to be 4 trillion, you've achieved 3 trillion. Between 1.5% and 2.5%, based on how you performed, we are allocating this much money to you, such that now it's performance-based and not as much discretionary based on the Cabinet Secretary for Treasury. Therefore, my proposal would be introduce a clause in the Finance Bill 2025 to delete the words not exceeding 2%, and also to include one not below 1.5% and not above 2.5%. Let Kenyans, through their legislative representatives, be the ones to decide how much KRA gets for the work it has done. Lastly, my 10th and last proposal is on introduction of office to say that specifically deals with issues of the EAC, and this is with respect to tax, noting that tax rates above, there has been a bit of friction between member states on the EAC, and there is no coordinated effort by us as Kenyans through KRA, which is mandated to advise government on all matters relating to administration and collection of revenue, on harmonization of tax rates across the region, and also sort of EAC cross-border payment system master plan. So the proposal is to have a clause that gets KRA to essentially oversee the process of how are the tax laws across East Africa being made. How do they affect Kenya specifically? And going back to the last point that you had mentioned, Chair, as before the group that was previously before me presented, was the fact that Articles 209 and 210 of the Constitution derogate the power to impose custom duties on Parliament and essentially the national government. And the decisions made at EAC block level that have an implication on Kenya's tax regime should be ratified by the National Assembly, such that we're not just taking up what is made up at EAC. Yes, we do have what we call the East African Community Customs Management Act, which we have accepted to be our law on customs across the region. However, some of those laws are not harmonious, and they don't essentially marry with what Kenya has as its plan for taxation. Yes. So to sum it up, those were my proposals. I'm hoping that the Honorable Committee is able to consider them and enact or adjust them accordingly. Thank you, Chair.
Thank you very much, Honorable Paul.
Chair, I don't know if I'll be out of order, but let me also congratulate the presenter because he's been very eloquent, straight to the point, and it makes our work very easy when we go and retreat. And if all other stakeholders were like him, then it would have made our work very easy because straight to the point, he knows what he's talking about. And that's it. We would have actually received very many Kenyans' views if we would have such kind of presenters. Thank you.
Thank you. Thank you, Chair.
Thank you very much. Peter Manda, you are spot on. The conversation we had on KRA is something that they were also presenting to us last week. And it's good to see they have a supporter out there and appreciating the great work they do.
Thank you.
You are the Director Deputy Commissioner to be in charge of East African those ICMA thing. I think it's also very much spot on. The proposal to introduce exemption on spectrum licenses by telecoms. This proposal was in the finance bill of 2024 that
yes.
we lost, unfortunately. And so, yes, thank you. You make very candid presentation. We'll try to carry the best, as many of them as we can on our report.
Most obliged, Chair.
Okay.
Thank you.
Salamiane Kiambu.
I will do. Thank you.
So we've covered some very good base today. We've done with our stakeholders for this Tuesday. A big round of applause for all of us. So we continue tomorrow through Saturday, and then we start the counties on Saturday. We go to the 10 counties that we agreed we go to. So it being 5 or 2 p.m., meeting is adjourned until tomorrow morning.
I had a question, Chair, though you've adjourned. Monday being a public holiday, will it affect the county movements? Is Monday, I think Monday is a public holiday as a result of Sunday. I'm asking, will the public holiday on Monday affect the counties?
We have set up the program considering that Monday is a public holiday, so it's well taken care of.